Hi, everyone. I hope you're all doing very well. I think I'm live. Yeah, I'm live. Okay, guys, I wanted to do a live stream today, and I wanted to talk about investing during periods of slower growth. Last year, we had a year that, on the outset, in my view, it was very obvious that from an economic perspective, it was going to be quite strong. And in hindsight, we had a pretty decent year with real GDP coming in at 2.9%. Now, real GDP is growth on top of inflation. So despite having huge amounts of inflation, GDP was not inflated just because of inflation. It was also inflated because of the credit cycle was booming and aggregate demand was actually quite high. Last year was quite good, but the cost of capital increased at such a significant pace that we ended up seeing multiples come down at such a rapid pace. And that's ultimately the story of last year. The macro story, the problem with listening to macro analysis is you can explain anything away with macro because it's very subjective. And when I started off investing way back when, the first thing that really caught my attention was, why do asset prices go up in the first place? Okay, well, earnings drive asset prices. Great. Now, what drives earnings? Okay, then you start to get into the weeds of macro, but the 3% of macro that's important, credit cycles, right? So debt. And that's ultimately what I want to talk about today. Growth is almost certainly, in my view, going to slow down. And I think it already has. I mean, if you look at GDP now, I know it's very early, but Q1 GDP is coming in at 70 basis points, real GDP. That's inflation plus growth on top of it. It's still very early. That's going to be very volatile and it's going to change a lot. Could be positive or negative. It doesn't matter. But growth is almost certainly to slow down, mainly because we've got a negative yield curve, and we'll talk about that later. So credit markets might seize up a little bit. And as well as that, we've got a situation where excess savings is starting to dwindle. And as well as that, comps year on year. Last year, we had very strong economic conditions. And this year, it's going to have to comp a really good, strong year last year. And that's going to be quite difficult. So we are going to get slow growth. And the question is, where should we be allocating capital? And that's the point of today's update. So before I get into it, this is correspondence with copiers on eToro. If you guys are watching it discretionally, actively managing your own capital, that is perfectly fine. But you're responsible for your own decisions, not me. So if you take any of this out of context and you make a decision on it, that's entirely up to you. Okay, let's start off here. I've just got a couple of charts that I wanted to pull to show the cyclical nature of the business cycle. So we're heading into a slowdown, but there's still likely to be a couple of years left of the business cycle. Today, all the macro experts, I believe what they're getting wrong is they're looking at the 1970s, 1980s. And outside of inflation, there is nothing in common today with the 1970s or 80s. There's nothing in common with regards to demographics, labor markets. The inflation that was caused back then was caused by energy. We're already starting to see energy roll over. There's a lot of, it's completely different. Today is very similar to, in a way, 1970 Spanish flu pandemic, where we had a very brief depression in 1920, 1921, before the 1920s. You had a Federal Reserve president. His name was Ben Strong, and he was Fed chair until his death in 1928. Believe it or not, the 1920s, we called them the Roaring 20s, but we had 4 recessions, right? So there wasn't really anything roaring about the 1920s. Why did equities go in a linear fashion from bottom left to top right despite 4 recessions? Because Ben Strong had his hand on the printer and they just kept juicing the markets with liquidity all the way up to 1928 when he died. And then they tried to balance the books. 1930, they tried to balance the deficits. And we ended up going in from a recession into a depression. There was an awful lot behind that. There was a lot of political errors from, what do you call it? I can't think of the word right now, but when they start putting up tariffs, etc., there was a lot of that going on as well. But anyway, it's kind of similar to the 1920s in that regards. And it's also similar to the 1940s. The Fed chair during the 1940s was a gentleman named Mariner Eccles. And Mariner Eccles realized that inflation was sticky at the core level, because you had a contracting labor market. And the reason being is you had the World War going on, you had mobilization of capital and labor, and we had very sticky inflation. So Martin Eccles had to deal with high inflation, and yes, it was a wartime effort, but we had high debt to GDP at 120%, and he fixed the bond rates very low despite inflation getting up to 20%. Today is more like the Spanish flu, 1917 into 1921, and the 1940s than it is the 1970s and 1980s. And the reason why that's important is because the outlook moving forward is incredibly important. Inflation is very sticky, but it's sticky because we've got a tight labor market and inflation is pretty damn hot. Core inflation is pretty damn hot, mainly due to what's happening with the labor market. At the margin, rents, yes, have been pretty hot, but rents, you got to look at the breakdown of the housing market in the US. You got 65% home ownership rate, 98% fixed rate mortgages, only 2% are variable rate, they'll be hit. And the other 35% is renting. And so it's the minority that's going to be impacted by higher rents, not the majority. Fixed rate mortgages at 3.3% in tandem with high wage growth means that cash flow flows back into the consumer. So you got a situation where consumer is spending like a bat out of hell. Their saving rate's going down. They still have $800 billion in excess savings. That might slow down, but they're spending a lot. They're earning a lot. They believe that the prospects are pretty hot. And that's ultimately what's driving the business cycle. And the difference between today and 2008 is back in 2008, it was the household that was over levered and it was the government that were under levered. Today, the government's over levered and the household is under levered. So there's only so much you can do in terms of higher interest rates. And there is an argument out there that says, yeah, but government bonds are fixed rate debt. Yeah, sure, whatever. They're running a deficit, right? So they're spending more than they're bringing in. So if interest rates go up by $1, that's a problem. And as well as that, about $10 trillion of the debt is coming due in the next 3 to 4 years. So it's going to be rolling at higher interest rates. It's terminal. It's absolutely terminal. So here's a chart here. So if I go down here, I just marked it out here. This is ultimately, it's a very high level sort of rudimentary view of what drives the cycle. You have consumer sentiment, which includes job security. And you can go to the University of Michigan, for argument's sake. There's like, 100 questions. You can break them all down. And you can understand the different elements where the consumer is very negative. So if you look at consumer sentiment for last year when inflation was hot, very negative towards sentiment, job prospects, very, very, very bullish. And so if you broke it down, you could see those granular details in consumer sentiment. So we had a situation where job security was perfectly fine, and job security leads to consumption. Higher consumption leads to higher credit growth. Higher credit growth leads to higher employment, higher GDP, consumer sentiment, and it has that sort of circular effect. And that's ultimately what drives these short-term business cycles. The business cycles generally last 5 to 7 years, and then you have this long-term debt cycle that usually lasts an entire life, the life expectancy of a human. So if you go back, if you read the early stuff from Ray Dalio, where he's analyzed in the early 1900s, the debt cycle was 60 years, according to him, the long-term debt cycle. And if you go back and look at the average age, life expectancy in the United States, back in the early 1900s, it was 46 years of age. That's not because people didn't live to 80, 90, 100, but it is because we didn't have sort of medical developments and people were catching viruses, they were catching the flu, pneumonia, etc., and we couldn't cure them. So there was just a high fatality rate back then. And that's why the average age was 46 years of age. And the death cycle only lasted about 60 years. Today, if you look at the average life expectancy, it's different in each different region. It's like 78, 80 years. And if you look at the long-term debt cycle, we peaked out back in 1946. So if you consider where we are as of right now, 121% debt to GDP in 1946. Fast forward 80 years, we're back to 121%. Big, massive loop. And that's the long-term debt cycle. We're about to go into a cycle of deleveraging over the next probably couple of decades. And so while we have these deleveragings and releveragings, we have these short-term business cycles that last about 5 to 7 years, where aggregate demand increases and declines, and it increases and declines. And as you can see here, just as a reference, you can see we've got revolving credit. So this is revolving consumer credit owned and securitized on a year-over-year rate of change basis. And you can see these peaks and troughs happen a couple of years before. So this is year-on-year rate of change when this is growing obviously at its peak, and then it starts to moderate. We head into 1999, 2000. I should have a little green arrow here, but 2002, you have a short cycle in 2006, 2007, and then you're into 2009, 2011, and And then you're in 2016, 2017, which led to the manufacturing recession in 2019. And then we had 21, and where we are as of right now, we're still at the peak of that credit cycle. So we have these business cycles which tend to go on for 5 to 7 years. And I actually think there's probably a year or two left from an economic perspective in this business cycle. If we have a look at the relationship here, it's a little bit messy, but what we have here is initial claims in blue, and I have it inverted. But you can see that these tend to trend in tandem with each other. So you can see that all of these cyclical factors, they all line up. It doesn't matter whether you look at PMIs, it doesn't matter whether you look at credit spreads, it doesn't matter whether you look at year-on-year growth in revolving credit. For those of you that don't know, revolving credit would be stuff like home equity line of credit, it would be credit card debt, that type of stuff. So it doesn't matter what you look at on a rate of change basis, all of this stuff sort of correlates. And as of right now, I think we've probably hit like peak growth, and we're going to start moderating throughout this year. And I would probably argue that in order to see a recession, we're probably going to need to burn through aggregate the entire excess savings that the household has, which is still about 800 billion. And when you factor in the income for households after the 6.4% growth last year, plus the 800 billion, you're not looking until a recession until the end of 2023, but growth's going to slow down. And then I think we're going to get a shallow recession because consumers in better shape than the government is. And the government keeps spending like a bat out of hell. So there's a big standoff between the Federal Reserve and the US government as of right now. Who wins? I would say it's likely to be the government, simply because I think it's Federal Reserve Act section 10.1 or 10.1b suggests that during a times of crisis, the president of the United States can fire the Federal Reserve chair. So that's on the table if things got as bad as it possibly could. So Jerome Powell's job is not as secure as what a lot of people think. And as well as that, James Bullard, good old Jimmy Bullard, who is the most hawkish on the panel, he won't be voting anymore this year. And so things are changing at the Fed, where some of the major hawks won't be voting for 2023. James Bullard obviously being the most notable. So as we move forward, I think we're probably close to peak rate hikes. When I say peak rate hikes, we've priced in another 25 basis points next meeting, and then I think another 25 basis points after that. What I'm saying is the market's already determined peak, and we're already looking through that. We're looking into the future, where we're actually looking at a rate cut into the end of the year. And over the past 4 to 5 years, what have we seen? The market be dead right, and the Federal Reserve just completely lose credibility. And Mohamed El-Erian came out recently, and he said the Federal Reserve should come out and do a 50 basis point rate hike because the market's completely lost respect for the Federal Reserve. And that's what's happened. The Federal Reserve made some terrible errors, not just through COVID. If you go and listen to Kashkari back in 2018, he said we should raise interest rates because of fiscal stimulus. Remember, Donald Trump cut interest rates, corporate tax rates come down, fiscal stimulus is driving the business cycle. Kashkari comes out and says in February 2018, we should raise interest rates. Fast forward to, I think it was about May 2019, the market had crashed obviously in late 2018. And Kashkari says there was no precedent for raising interest rates. Can you believe that? Inside 15 months, a Fed president comes out and says two sides of the same coin. We should raise interest rates, and then a year later, we should never raise interest rates. So it hasn't just been since COVID. This has gone on for a long period of time, but it's been amplified during COVID because we had such gyrations in inflation. So that's ultimately where we are. I think we're likely to see growth slow down for the reasons I mentioned a moment ago. We're going to see very difficult comps, strong growth last year. The other part of it is understanding how credit is actually created. So I'm going to actually share my screen here with the whiteboard, because I've got another chart, which I did show you on an older stream, but let me see if I can find it here. But it is going to be important for explaining how credit works, or just a very rudimentary view. It's not about getting this down to a T. It's about having a high level view of what actually drives this stuff. So then you can better, when we get to a little bit later in the stream, we can start talking about, positioning, etc. All right. So there's two different ways in which credit is created. The first way in which credit is created is through central banks. So central banks will mint reserves, and with that, they will be able to go out and buy what's known as mortgage-backed securities or government bonds, which makes up, I think, roughly 95% of their balance sheet. And so if you think about it, the government goes out and buys US government bonds. The government now has all this cash. What do they do with it? Deficit spending. And then they go out and spend it in the economy. So that's cash entering the system through the government raising debt, through maybe quantitative easing or something like that. The other way is through commercial banks. Now, when credit is created at a commercial bank, every loan needs to be backed by a reserve. So we kind of got a bit of a glut in reserves as of right now. But every loan that goes out the door needs to be backed by an equal amount of reserves. So to some degree, credit is controlled by the central bank, but it's still discretionary. So there's a couple of caveats here. Caveat one, banks need to be willing to lend. That's going to be important when we talk about that in a second. And customers need to be willing to borrow. So if you look at last year, consumer confidence was in the gutter. Now, to anybody that takes this stuff serious, you would break down all those questions and figure out, okay, what part of this sort of index, the University of Michigan Consumer Sentiment Index, are consumers really dissatisfied with? And it was very obvious. The outlook for future prices was very, very negative, inflation. But there was other questions regarding their prospects on wage growth, their prospects on if they needed to swap jobs, on higher like all of this sort of stuff was very positive. So if you broke the data down, you realize consumer confidence, job security was very, very solid. Consumer confidence related to price inflation, very, very negative. Consumer confidence goes down, but because that job security is there, spending should be pretty hot. That's the assumption that we can make. And that's ultimately what happened. Credit growth last year was fantastic. And so consumers were willing to lend or willing to borrow, excuse me. And the second part of that equation is, were banks willing to lend out money? So when we look at banks, how do they make their money? Well, they essentially, now these are old charts because I was trying to explain this sort of concept about how credit's created. But banks essentially borrow money on the short end and they lend out money on the long end. And the spread, the difference between both, is the profit that the bank will make. And so if you think about it, you've got customer deposits, which will earn essentially an income on the daily rate. And then you have a 30-year mortgage. And the spread between the overnight savings rate, the customer deposit rate, and the mortgage rate, that's where the bank ultimately banks their profits. So when you have what's known as a steep curve, we end up in a situation where banks are very willing to lend money. So if we go down here a little bit, you have a yield curve here. The yield curve's in red. See what these high spikes, when you're looking at the 10-year minus the 2-year or whatever it may be, those high spikes are periods where banks can make a lot of money. Now, today, it's a little bit different because you have to factor in real interest rates with high inflation. And that's sort of what I was pointing out here. We had deeply negative curves back in the 1970s and 80s. But because of the high inflation, the real curve was still flat to slightly above. Banks could still do reasonably well. But that's not really what I want to get at here. I want to show that how a bank makes money and how credit's created and how the cycle actually works. So we're in a situation, this was, I have it here. This is as of November 17th, 2022, the blue line. The yield curve, if we're looking at the 1-month treasury bond, and you can get this at treasury.gov, the 1-month treasury bond, are these, I'm not sure if I chose real rates or not, I'm not sure, probably nominal, but that's the 1-month bond. And that's the 30-year bond from that date. And the curve was flat. It was completely flat. And what does that tell you? It tells you that if banks were to lend out money, they're not going to make anything. And so therefore, what are they going to do? They're not going to lend out any money. So that's ultimately what ended up happening. That's ultimately where we are as of right now, is the return on lending money is starting to diminish. So the credit cycle will probably start to slow down from here. Growth will roll over. It'll still probably be positive, but it'll roll over. Year-on-year comps are going to be very difficult. And we're probably going to see this slow growth environment into the end of the year because of lower, not just low, but nominal curves are deeply negative. Now, again, this is from November. It's probably the same date. This is from November. It's even deeper than that. So that's ultimately where we are, is we're likely to see this slow growth environment throughout 2023. And then towards the end of 2023, if growth doesn't pick up, we're likely to start transitioning into a recession. So let me go back over to my computer screen. I'm on the computer screen. Let me go back over to my Google page. If we go, I think it is, can't seem to find it. I need to pop it up here. There it is. So that's sort of like a backdrop of where we are. Just a high level view of this idea that growth is likely to slow moving forward. It's not going to be the end of the world. Just like 2022, in June I wrote a post in 2022 and I said, look, the economy is still very strong. And in hindsight, you can say, like, we all have factual data. The economy was fine last year. Wage growth was perfectly fine. At the margin, there are people that are getting hurt, absolutely, because of inflation, but the majority were perfectly fine. And so you can see how sentiment can really influence people's sort of expectations of what's likely to happen. But the reality is very different. Last year was very difficult because you had a situation where central bank liquidity was draining very fast. But from a commercial bank perspective, they were lending out money like it was candy. And that led to obviously real GDP being very positive on top of inflation, and it was a very reasonably good year. That's what made last year a little bit more difficult. Now, if we start to see that slowdown in tandem with energy prices, and we continue to start seeing headline inflation roll over, we're going to continue to price out rate hikes. We start to see liquidity flow back in. Liquidity jumped massively over the past 3-4 weeks, and it was largely driven by the Bank of Japan buying a hell of a lot of US treasuries, bringing rates down, massive injection of US dollar liquidity. Eventually, they're sort of short-term fixes, but eventually I can see a scenario where the Federal Reserve will start cutting interest rates. That's a given. The question is when. And as of right now, the market's pricing that in at the end of 2023. So we'll have to wait and see. So the next part is what do we invest in, right? So we have a slow growth environment. What exactly do we invest in? There's a couple of things that I want to share. So if you think about it, what drives earnings? Let's go over this again. What drives earnings? So we've got a couple of things. We have earnings. What drives earnings? So one would be this business cycle credit growth. Two would be inflation. And three is operating efficiencies. And or market industry mix. What I mean by that is that sort of industry mix is back in the 70s, like a lot of people are looking at profitability and multiples from the 1970s and 1980s, and they're comparing them to the market today. And they're saying the S&P 500 has to trade at a 10x multiple. And the reasoning behind that is because it did back in the 1980s. And the reason why that's a big mistake, forgot an or there in industry, but it doesn't matter. The reason why it's a big mistake to look at it that way is because the market was dominated by manufacturing, industrials, etc. back in the 1970s, 1980s, whereas today you have much higher margin, more profitable businesses that trade at much higher multiples that are self-funded, that are dominating markets in the tech sector and whatnot. And so the multiple, I don't see it going back below 10 unless we were dominated by manufacturing, and I don't see that moving forward. You just seen in the past couple of weeks, we had ChatGPT come out. Just as an example, that's the next wave of more, I guess, productivity, innovation using AI. So technology is not going anywhere. It's still going to be a very dominant part of, or a dominant percentage of the market makeup, meaning that the multiple is going to be a little bit higher. But operating efficiencies could mean, like you look at what, Crocs were able to do. They had a specific region where labor got very expensive. Well, they're pretty agnostic to talent. So what they can do is, shut down a plant, move closer to where their demand is. They can open a new plant, get a couple of no-skill labor for next to nothing and start manufacturing goods right away. There's a labor shortage. They don't have to participate. That's operating efficiencies to maintain a very high margin. They can just pack up and leave and go somewhere else. So there's a lot of these. Different, company-specific things that management can do in order to create operating efficiencies to grow earnings. The other one's obviously inflation. If at the margin you've got something like Builders FirstSource as an example, let's say lumber prices go up, well, they take a 10% fee. It's like a tax. Just as an example, let's say lumber prices go up. Well, in that scenario, if they're going to take a take rate of, let's say, 10%, well, their earnings are going to go up in tandem because they're getting a percentage of that commodity. A lot of businesses that are like that, where inflation actually drives their earnings, and then credit growth, right? So general demand, which obviously feeds into inflation. So when we're looking at what drives earnings, we are looking at where 1 and 2 is likely to slow down. So the next question is, who's going to buy our companies? If earnings start to not necessarily grow, and we're going to see a scenario where there's a possibility where we start to see maybe specific companies and industries and sectors start to underperform, what type of companies do we want to invest in? The companies I think you want to invest in, I've been thinking about this a lot recently, and I think some of the companies that you could invest in are companies with stable earnings, right? So I'll go through an example of this. I'll just put STABLE, stable earnings, and so I'll just leave it as earnings, and levered to the gills. And the example that I'm going to use for that is a company which I was thinking of buying a couple of weeks ago. Unfortunately, I didn't. It's a company called Qurate Retail, QVC. And so if we have a look at this business, I've been following this one for a while. It's one of Malone's businesses, very similar to Warner Bros. Discovery, Charter as well. It's one of Malone's very heavily geared businesses, but these could be very interesting moving forward. So if you break down the numbers behind Qurate Retail, you're actually seeing expenditure from the 18 to 24-year-old category increase. Over 55s is still as stable as ever. And so you get a situation where the business fundamentals are actually getting slightly better. If you don't know what QVC is, in the United States, they have these shopping channels, and it's like somebody will stand there and they'll show you this gold chain, and it might be a pocket watch or something like that, and they'll explain it, and then they'll give you like 10 minutes to call in or make an order for that specific pocket watch, whatever it is, and you'll get like a 20% discount. And it's incredibly popular. So the earnings for the business, although it might be discretionary and certainly cyclical, the earnings have been very consistent. And given that the consumer is still in reasonably good shape, earnings could be perfectly fine. If you actually have a look at the numbers behind QRTEA, Qurate Retail, if you have a look at the numbers behind this, so first and foremost, the market cap was as low as 600 million. Now the enterprise value, they do have a lot of debt, but it's fixed rate debt. It's not maturing until like 2029, between 2029 and 2031 is when most of that debt's maturing. And you got a situation where, if the earnings are stable and the multiple is fair. So if we pop on over here and we see what the market was willing to pay for this. So we look at enterprise value to EBITDA since inception, the market's been willing to pay 6.11 times. Let's say it stays at 5.69 times. I don't know if you guys can see that, but let's say it stays at 5.69 times. The average has been, as I mentioned a moment ago, 6.11. But if it stays where it currently is, and you take your cash flow, so let's have a look at what the cash flows anticipated to be. Historically, cash flows have been very strong outside of last year because they had a fire. But cash flows are anticipated to be, last year they were 775 million. This year they're anticipated to be 700 million. Next year they're anticipated to be $1 billion. The year after that, 1.1, 1.25, and so on. 700 million this year is 70% of the market cap. So if you were to take all of that free cash flow, pay down some debt, and the multiple's played at 5.69 times, what needs to change? You need to readjust to factor in a much higher equity valuation. So the equity would need to go up 70%. And so those sort of anomaly opportunities, and this is one that Burry mentioned, like very vaguely, had mentioned on his Twitter, he had said that, I think he called it a statistical anomaly, that it had to go up. If earnings were to be stable, it was a statistical anomaly where it had to go up. That's essentially what he's talking about. There's a lot of companies out there that have an awful lot of leverage, such as Charter Communications. Every dollar that comes in the door, levered up 4.5 times, buy back stock, and the equity continues its bid. So when we're investing in companies, most people think, well, it's only you, I, and every other market participant that drives the price up. That's not always true. When you have a really depressed equity valuation, and you've got a situation where the income is stable, it's fixed rate debt, so variable interest rates doesn't even matter. This is a company that all they can really do is delever. So what happens? Let's say in this scenario, they pay down $700 million in debt. Well, let's say the interest on expense on that was like 10%, which is probably not far off the truth for QVC. I haven't looked at the debt, but let's say it's 10%. That's 70 million in interest expense that now goes back into your cash flow for the following year. So let's say your cash flow doesn't grow. So you just use the 700 million to pay down debt. Your equity revalues much higher. Now you got 770 million. So you got more cash flow with zero growth. And the equity price re-rates higher as the bid is coming from the company itself. Lots of companies like that. So that's one way in which you can generate outsized returns. The other way in which I think you can generate outsized returns in this market environment, I'm just showing you some companies that I'm looking at, but there's companies in the portfolio that are all exactly the same as this. Another one would be something like Hasbro. And Hasbro, to me, is a really interesting company that's mired in a lot of controversy right now, which is great. I mean, you're not going to buy a company at a great valuation if everything's running smooth and everybody loves it. They don't exist. And I always use the example back in the days when I used to do the videos on individual equities. I done one on ExxonMobil, which is a company that I used to own. And when I bought it, I think it was like $28 or $26. But the company was borrowing money to pay its dividend. And that's where they were in that specific moment, but it wasn't where they were going because the energy prices were moving north, meaning the cash flows were improving, and the rest is history. I mean, now it's trading, I think, got up to about $100 a share. But at the time, everyone hated it. The sentiment towards it was very negative because there was something broken. They had to borrow money to pay the dividend, which is never a good scenario to be in, but that's a very cyclical business. And when those businesses look like trash, that's the perfect moment to buy them. I'm not going to get into that specific company, but I'm just explaining a very extreme example of that where a company looks terrible, but it's actually probably one of the better investments that you can make at that moment. Hasbro looks terrible right now. They just gave initial guidance, not very good. I think they're expecting was a 129 to 131 EPS, which is down from expectations of 168, and they're going to fire 1,000 people. So if we look at Hasbro, like what's very interesting about this, you've definitely bought something from Hasbro. If you have kids or you were a kid recently, you've definitely bought something from Hasbro. I'm almost certain. So think of it this way. Back in the 1980s, Warren Buffett has an interview. You'll find it actually. It was one of his annual conference calls. And if you go back, I think it was the 1980s, you'll find it anyway. And he's talking about Disney. And it was really interesting. It kind of stuck in my mind for a very long period of time. But what he was saying was Disney is really interesting because Mickey Mouse, for argument's sake, is the content. So you have this content. And the content is the money in the bag, right? That's kind of why I like Warner Bros. Discovery. The content's the money in the bag, and that'll never change. Just I think it's on Disney. Pinocchio was from 1886. So 140 years later, what did Disney just do? They just brought out a new Pinocchio movie. That's not new IP. That's old IP. Here's the interesting thing about when you have that type of IP is what Buffett was saying is the innovation occurs in the distribution of that. So look at Netflix. Netflix took cable television and turned it into direct-to-consumer. And so that gave companies like Disney, as an example, a new avenue to actually generate more cash flow. Direct-to-consumer platform, to resell, that's the innovation. The content never changes. And the reason why I bring that up is in Hasbro, they also have content that'll never change. And to give you an example, they have stuff like Monopoly. So you have Monopoly, right? So back in the 1990s, Monopoly was a board game that was developed. I'm sure you guys have it somewhere in your house or you bought one. I'm almost certain. But this was a board game for kids. And I wanted to give you that example with Pinocchio and Disney and what Buffett was saying about the content being the money generator, because it's really, really, really relevant when you look at franchises like Monopoly. So Monopoly has a license agreement with an application development company to develop online app versions of Monopoly. Now, they don't have to build it. They don't have to find customers, but they do receive a licensing payment. And here's the beautiful thing about that. Despite this being a discretionary company, because it's gaming, that licensing fee is non-discretion. So they have the content, which is a board game. And off that board game, they're able to sell many different licensing agreements through different innovations. We also own a company called Evolution. So Evolution is an online gambling casino. They more do the back end sort of stuff. They partner up with different companies. But one of their offerings is it's Monopoly Online. And I'm almost certain when the developers of Monopoly developed Monopoly in the 1990s, they never, ever, ever considered selling the licensing to an online casino and generating cash flow for that. And here we are. So when you have that type of IP, and it's like what Hasbro has is nothing like Disney, but it's also not priced anywhere close to what Disney is. But when you look at like some of the franchises that they have, where Transformers, right? Licensing, look at the movies that were made on Transformers, the games, everything, video games, all of that sort of stuff, cartoons, Nerf games, the Nerf guns, all of that sort of stuff, that's all owned by Hasbro. Twister, board game, all of this stuff is owned by Hasbro. And those assets, I think, are very valuable. They also have, I think it's World of the Coast, which generates 50% of their EBITDA. Connor Haley of Alta Fox believe that's worth about 70% of the market cap. And if they spin it off, they'll be able to generate a lot of cash flow. So basically what I'm saying is when we start to see a slowdown in growth, when we start to see this sort of market environment where it's not too hot, not too cold, it's pretty bland, how do you make money? Obviously, valuation matters. So I wanted to start off with Qurate Retail to give you an extreme example of a company that if nobody else wanted to buy it, the company itself will buy its own shares. And they'll continue to do levered buybacks. And that'll be the same for companies like, eventually, companies like Charters, obviously doing it, Warner Bros. Discovery. These are companies that'll pay down their debt, but it'll have the same impact of buybacks if the market prices it at the same multiple, which are very depressed. You've seen a moment ago, Qurate Retail is at 5.6 times enterprise value to EBITDA. And so that's one way. You look at Hasbro. So in a market environment where growth is slowing down, discretionary companies might start to see downgrades in earnings. So you want something that's non-discretionary. So Hasbro gets the best of both worlds because of what I mentioned a moment ago, the licensing contracts that they have as well. That generates an awful lot of revenue for them. That's non-discretionary. If, let's say, there's a contract written on a Monopoly game for new innovation, whether it's in gambling or whatever it is, and that's like a 10-year leasing agreement. If we go into a recession, you can't say, hey, listen, I don't want to pay it. It's a recession. You got to pay it. And so that licensing revenue is non-discretionary, and it's also non-cyclical. And that makes this business a little bit more durable. When you break down the debt for the company and the cash flows, they got 545 million. They've got a lot of their debt is 2027 and out, but 2024, 2025, there's some maturities. If you factor in the cash flow plus cash in the bank, they have about 3 or 4 times the cash that they will generate to service that debt. And if they pay it down, again, same applies. The equity will have to revalue higher. And so these are sort of some of the companies that I'm looking at where they're really good, deep value to an extent, depending on what you're looking at. Where if there's no bid, these companies have some degree of stable income that they can essentially buy their own stock. The other type of company that we're looking at, let me give you an example. Let's see the portfolio, which one I could, well, actually, I'll give you an example of one that I'm looking to buy at the moment. Well, there's a couple that I'm looking to buy at the moment. We have some cash available and I know where it's going to go. I'm just waiting to put it to work. But one company is Lumentum Holdings. A lot of people are out there rushing into companies like for Mobileye or whatever for essentially driver, self-driving and whatnot. A lot of people are out there rushing into Apple for AR, VR and Meta AR, VR. And I like Meta. I love Meta. I think it's going to do very well. But Lumentum never gets a mention. It's a much smaller business. And it's probably, in my view, going to have a much bigger tailwind because they have like these 3D cameras, big partner with Apple. 30% of the revenue comes from Apple. Apple are announcing the AR, VR cameras that are very dependent on these 3D camera sensors. So you have the upshot of pretty massive wide tails in terms of growth with self-driving, LiDAR, with 3D camera sensing, and they already have the partnerships with companies like can't think of it right now. It's a lot of stuff in my mind. Apple. They're also in the communication space. So Charters, company we own, they just increased their capital expenditure by 5.5 billion. And it's $100 per customer. And one of their competitors, which would be Comcast, increased their capital expenditure by $200 per customer. And guess who supplies them with products and services? Lumentum. So as they increase capital expenditure, that gives them a big, massive tailwind. So number one, you look at companies like Qurate Retail, deeply undervalued, heavily debt laden, stable income, buy back stock, or pay down debt. Equity should re-rate. And we've seen that more recently. It could be volatile, but the outcome is likely to be the same. The second type of company would be non-discretionary type income. And the example we gave was Hasbro's. Hasbro's has a lot of licensing revenue, irrespective of market environment, they're going to receive that. As of right now, it's getting its ass kicked in the market. And that's where you should be getting most excited, not when share price is up 100%. And then finally, companies that have big tailwinds in terms of growth. So even if we do have a slowdown in growth, that might be broadly speaking. So if you look at the housing market, it's about 5% of GDP in the US. Let's say that gets cut in half. So all of a sudden GDP could be flat for this year, directly related to the housing market. That doesn't necessarily mean that new markets like Apple, I don't think they've even started to roll out an AR, VR headset. And so that hasn't even started yet. And even if that's a flop, you look at companies like Lumentum Holdings, even if that's a flop, this is only a $4 billion business. The demand for that alone is going to drive their revenue through the roof. And so even if it's a flop from a company like Apple, because it's so big, this company is still likely to do very well. And so if you can find those high growth businesses, and again, it's not an expensive business. Trailing 12 months, there was a couple of adjustments on their earnings as that normalizes next year. It's trading at about 10 times earnings. It's about 11 times now after the run. But these businesses have fantastic growth opportunity, very profitable, big, massive tailwinds, cheap businesses. So they're the three types of businesses that I think will do very well throughout the year. I'm less inclined to look at the indexes because although it's improved a little bit over the past year, the indexes still have a lot of concentration. So it's not a fair reflection broadly of equity performance. And so I'm not really too concerned what the markets do. Broadly speaking, I'm leaning towards higher highs, mainly because in the last update 2 weeks ago, we were talking about liquidity easing a little bit. And as liquidity eases, you start to see a pretty decent performance out the other side for interest rate sensitive assets, liquidity sensitive assets. And one barometer of liquidity would be like Bitcoin, for argument's sake. And you can see that this is just absolutely screamed out the gate. Over the past couple of weeks, again, you've seen liquidity ease to some degree over the past couple of weeks, and that's ultimately why markets are up. If that remains the same, if we've already seen the bottom in liquidity, I can't imagine equities are going to make a lower low. So obviously I'm biased here in assuming that there is possibly a low in place, but it really doesn't matter. It's 500 companies inside the 504 companies in the S&P 500. There is 3,100 companies that I follow. Like when I say I follow, I don't follow 3,100 companies, but there's 3,100 companies that are above $1 billion that I can invest in. And so that's, of those 3,100, if the markets go down, it doesn't mean all 3,100 go down. And that's sort of what I'm leaning towards. So that is that. There's a couple of comments here. Hi, Clyde. Hi, Alan. Love the live streams. Delighted to hear. Ronnie's asking if I personally tried ChatGPT. I did a few weeks ago. I think it could be very good for domain experts. So if you're a domain expert, and here's the problem. I can tell you right now, everybody, I would say 99.9% of people on this planet are super lazy. And they'll put a question in there, a prompt or whatever, and ChatGPT will throw something out and they'll take it as fact, just like every other headline. And what I've seen anyway, I've asked it some questions, very specific questions on different companies and whatnot, and I found a lot of mistakes. So I'll give you an example. Lumentum Holdings as an example. This is a company that was to go and buy Coherent Incorporated. They had a merger agreement, I think it was in 2019, and that deal fell through. Coherent ended up merging with IIVI, semiconductor play, and the deal broke off. ChatGPT still, and here's the thing, ChatGPT is trained on 2021's data, so it already knew this, or it should have known this, but it's given the wrong information there. And so if you're a domain expert, based on its current form, I think it's fantastic. But if you're not a domain expert and you're looking for broad advice, I think you need to double check everything. It's not plugged into the internet yet. So I don't know if I don't know if even Microsoft have the resources to deal with all of those tickets or requests. I don't think they even have the budget to deal with that. They plugged it into the internet right away. So I don't know. It won't. Eventually, it will. You'll see the cost come down significantly, and I think you'll see a situation where ChatGPT becomes far more economical. But as of right now, it's not connected to the internet. So we'll see what happens at some point in the future. But I think if you're a domain expert, it's really good. It's really good, but you just got to be very careful from mine. Intel also looks like trash. Maybe. I have no idea. Not following it. All right. There is a couple of questions. There is a couple of questions over here. So I'll just bring this over. All right. So let me zoom in here. This is the right one. Yeah, it is. So Cheka, I met recently an IT sector, an IT manager at Bitfarms who advised me Bitfarms is a superior investment compared to CleanSpark because CleanSpark is poorly managed. What are my thoughts between the two? So, okay, I'm glad you brought that up. I'm glad you brought that up because I'm a little bit disappointed with CleanSpark's management at the moment. So first and foremost, from an operating perspective, CleanSpark is ran very well. And here's the thing, CleanSpark are, if you listen to them, they're shitting on every other player as well. I don't know what kind of childish management executives Bitcoin mining companies have, but they seem to have very big egos despite being down 60-70% over the past year. So both of them, that's a very biased view from somebody that works from a specific company. CleanSpark done incredibly well last year from a performance perspective. However, this is one thing that we need to keep an eye on. So I'm looking at the overall dilution of the company, and relative to the growth in exahashes, which they tripled the business, the equity has grown about 130%. So the business has actually grown. Their ability to mine Bitcoin has grown by about, I'm out of the, there I am there. Their ability to mine Bitcoin has increased. Even with a higher hash rate, they're mining more Bitcoin. So let's just pop on over here and have a look at financials. And I'll get into this a little bit more in detail in a second. If we have a look at the cash flow statement and we have a look at stock-based compensation, you'll see it's starting to get a little bit egregious, 31.46 million. Last year, 30 million of that is the chairman and it's the CEO. $30 million of that stock-based compensation. Let's pop on over here real quickly. You'll see wages, payroll expenses, $40.92 million. 30 million of that, 77% of that was the CEO and the chairman. Now, this is a company, like, again, when you look at it overall, the business still performed very well, but this level of compensation is absolutely egregious in and of itself. And that kind of gets under my skin a little bit. Now, that's fine until about 2 weeks ago. They reported earnings, and on the day of earnings, they issued an SEC filing. And on the SEC filing, they said that they want to increase their ability to raise capital to $500 million. And they said, like, it's going to be for M&A deals. It's going to be for essentially building out a business in a bear market. Okay, whatever. They've done some very strategic assets, buying Argo Blockchain's mining equipment at an 86% discount, really high-end mining equipment, SJ90s. And so I was like, you know, it's leveraging the company up quite significantly, and there could be some misallocation of capital, but they've made some good decisions so far, and they haven't found any ideas that they were going to essentially invest in. So from that perspective, I wasn't really too concerned about it. Then we have the vote, and the vote comes out, and on the vote, there's a couple of surprises. So there's 5 different questions. The board of directors, look, I voted for all. I mean, from a management perspective, I think they've done reasonably well. That being said, maybe I should have voted individually. Probably give the vote to Zachary. Wouldn't give it to Matthew. The chairman is, well, he's the chairman. Maybe I wouldn't give it to Zachary. Yeah, I'd take Zachary off. He's the CEO. I wouldn't want him on the board at all because I'd like the board and the management to be independent of each other. There's a little bit of overlap here, so that if the management are useless, they can get fired. Anyway, I voted for all. Down here you have to authorize and approve that our current articles of incorporation as amended and restated to date be amended to increase the number of shares of common stock authorized to issue for issuance thereunder from 100 million shares to 300 million shares. Okay, that's perfectly fine as well, because we knew 2 weeks ago they wanted to raise up to $500 million via equity issuance. Okay, whatever. At the time, the share price was like $2 or something like that, or $1.87. So 100 million shares, you can only raise 187 million. So they decided, look, let's increase the number of outstanding shares to 300 million in order to factor in their desires to possibly raise 500 million. Okay, I voted against that, even though I was like, man, it's, you know, if they do good M&A, it's going to be a pretty good feedback loop, whatever. The reason why I voted against it is because of number 3 here. To approve an amendment to our 2017 incentive plan, as amended today, to I, increase the number of shares authorized for issuance thereunder from 3.5 million shares of common stock to 11.5 million shares, and I, and part 2, add an evergreen provision 2 on April 1st and on October 1st of each year, automatically increase the number of shares of common stock available under the plan to 15% of the company's outstanding shares. This is where it gets really, really, really shady for me. And yes, I am a shareholder, and yes, I was very bullish on the company. I still am, but I've got to be very straightforward with how I'm feeling about this. What they've created, if this gets passed, I voted against. What this creates is the incentive cost bias for management to issue as much shares as they possibly can, raise $500 million, invest it into any M&A deal. It doesn't matter what the return on invested capital is, because once all those shares are issued and the entire enterprise value of the business increases, the number of outstanding shares available for stock-based compensation increases. So these two are two little greedy pigs, where 77% of last year's payroll expenses, 15 million each, go to the chairman and the CEO. And it's not like it's like this incredibly high-skilled job that's requires the best of the best management. It's not that scenario at all. And this is where I'm starting to get a little bit iffy. So to your question, from an operating standpoint, I don't think they necessarily done anything wrong, but it kind of feels like a quasi embezzlement in some sort of legal manner. And that's sort of what they're trying to set up. So look, every morning I get up and I go over here and I go to the SEC and I click on company filings and I go to CLSK and I click on CleanSpark and I look at the ownership disclosures. And if they start selling their stock, I mean, I'm going to have to make some serious decisions. I look at every single filing that they issue, but I'm going to be following this very closely for M&A deals. If they start selling down their stock, it's just a total corporate raid without them actually putting dollars into the company, which is pretty disappointing. And as well as that, anything that I see shady, I'm just gonna tweet out to the CEO and the chairman and just, you know, let them know that, you know, Goldman Sachs cuts the CEO David Solomon's pay by 30% to 25 million. So this guy here, Zach, this guy here got paid 15 million last year. And Goldman Sachs is 500 times the size of CleanSpark. And they do 50 times its market cap in net income. So I think it's very important that, at least while I'm a shareholder in it, that publicly we can disagree with these guys, because that's egregious and it's very, 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 very disappointing. That being said, the reason why I invested in it is to get exposure, sort of like a leverage exposure to this rally in Bitcoin. And there are other companies that I like. The 3 companies that screened out is pretty good. The other 2 weren't as undervalued as CleanSpark, but the other 2 were Bitfarms, as you mentioned, and also Riot Blockchain. So they're also pretty decent alternatives if we decide that we don't want to be in CleanSpark. There is other alternatives. The vote's on March 7th, so let's see how it plays out. But yeah, it's sort of disheartening to see. I don't know about you guys, but I fly pretty close to the sun, and when I see this sort of stuff, like, we all work hard for our money, and we see this sort of stuff going on from management, it really, really makes my blood boil. Would love to know your thoughts on what, if any, impact you feel the money currently held in the reverse repo facility will have on the Fed policy and or generating liquidity going forward. So, okay. So for those of you that don't know, we have what's known as the overnight reverse. I'm just going to put ORP in to be quick. So we have the overnight reverse repurchase agreements. So when we have a look here, we have Fed funds rate. So this is the Fed funds rate. This is pretty much the overnight rate. It's at 4.1%. It fluctuates between 4 and 4.25%. So this is the overnight rate. Now, if you're a bank, you can, or you're a large institution, maybe Berkshire Hathaway or something like that, you can take your cash and you can put it into the overnight repurchase agreement every single day, and you can collect at an annual rate 4.1%. And as of right now, banks have $2 trillion sitting in there. And the reason being is there is literally no risk. It's risk-free. It's the only risk-free asset that we really have. Government treasuries are not really risk-free, but the Federal Reserve backing this stuff is truly risk-free because Federal Reserve can't really go bankrupt. I've heard people say that the Federal Reserve can go bankrupt, but I don't think that's necessarily possible. But look, I don't know the granular details of the plumbing of the Federal Reserve. So when we're looking at this as of right now, this has gone from a peak of 2.55 trillion to 2 trillion. So it's drained about $500 billion. Why? So let's pop on over to here real quickly. CME, interest rate probability tool. This is really important. This is really important. So if we have a look at the probabilities, you can see we're going to get 25% to 98.1% chance that we get it on February 1st, which is next week. And then there's an 84% probability we get another 25 basis points on the 22nd of March. And then after that, it's flat to slightly down. And so if the market starts to price in more rate cuts at some point into the future, you've got an opportunity where you can invest in 2-year bonds, just as an example, at 4.26%. And you can guarantee, I mean, the government couldn't, in theory, go bankrupt, but you could essentially drain out the ORP. So we could drain $2 trillion out of the ORP, and we could bid up 2-year bond yields, and we can collect 2.46% on any auction that comes up in the next couple of months at this rate. And so you can end up in a situation where we have the ORP, 2 trillion drained down, and then there's $2 trillion goes into buying treasuries or bills from the US government. And what that'll do is that $2 trillion gets raised by the US government. And what are they going to do with it? They're going to spend it. And where are they going to spend it? Well, social projects, fiscal stimulus, Medicare, Medicaid, whatever it may be. But it's going to filter down in some sort of way, shape, or form. So what impact will that draining out have? It'll have a positive impact on liquidity for sure. So that's kind of like a buffer that we see as of right now. But that will, in that scenario that I gave you, I just wanted to give you a bit of an example. Fed funds, 4 to 4.25, 2-year bond yield, 4.26. If there was an auction pretty soon, or if there's $2 trillion in bill issuance over the next couple of quarters, you could probably see an awful lot of ORP drained out into US government bonds. It will bring the short-term bond rate down. It would also give funding to the US government and give them a little bit of a runway. I think it'll probably be a net positive. We'll see. That's just an example of how it could work. Alan saying, any recent examples of Elliott wave analysis that you use to time the buying or selling of a stock? Okay, so I'll get to that in a little bit. Actually, I can have a look at it right now while you're on the stream. Let's look at it right now. So let me see where we are. So I added quite a few positions. So Charter is sort of one. We added this 337. So we actually added it somewhere in and around there. With Elliott wave, wave 2s can retrace up to 100% of the wave 1. But generally speaking, the golden ratio is like 61.8% Fibonacci. So if I measure this up, somewhere in the ballpark at 337, which is our average price, that's where I bought into it. It continued to sell off by about 11% before it started recovering thereafter. So that's maybe one that kind of worked a little bit. Recently bought into 3M here I thought that the correction might have completed there, but it ended up pushing higher than A, B, and a C before pushing lower again, and I bought some more in the last week or two. It's down today because Johnson & Johnson lost their appeal on the talcum powder scenario, their issues. So it kind of sold off there, but their retained earnings are $48 billion. I think they'll be fine. So this is one where I added here. If you look at the two ads on the days, you'll see one addition was here and one was here. So if we were going to time our ads, I mean, that would be pretty decent. We added more to Digital Turbine down here on the lows, A, B, and C. So far it's very messy on the upside, but so far so good. I don't know. There's a few like that. Evolution, we have an average price where we bought it right here at 991. So going to lower time frames, what do we see there? A, B, and C on the downside of equal proportion. I wanted to build this out bigger, but this here was a shallow correction, so I only put 3% down. So we were able to get in pretty much close to the lows. That kind of so far has played out reasonably well. Ones that I kind of got wrong, like CleanSpark as an example, like this is the thing about Elliott Wave. Like if you look at, so the thing, like it's not just Elliott Wave either, right? So it's a combination of variables that you need to consider. The health of the business, right? So you got to look, you got to scrutinize its income statement, its cash flow statement, its balance sheet. Is it a stable, solid business? You got to scrutinize its valuation, whether that's like looking at its multiples. We'll talk about Citigroup in a moment, which is kind of like a unique example. But you got to scrutinize its valuation. You got to consider all these different variables. And sorry, my bell rang, just distracted me. I'm not answering it. But you got to consider all the valuations, whether it's a present value of cash flows, intrinsic value. If all those ducks are in a row, and then the chart stacks up as well, then the probability should be a little bit higher. Now, I usually use it to try and better time it. I had already decided that I wanted to buy, for argument's sake, Evolution. Jack in the Box is another one. Average price is $67. I had already decided I wanted to buy Jack in the Box. I just had to wait for that price. And so that's the last variable. Sometimes if you get all the other variables right, well then, if you get all the other variables right, well then it usually increases the probability of you being right here. So with Elliott Wave, when we look at CleanSpark, Elliott Wave would suggest like it's sort of like a series of rules where you have 5 waves up, 3 waves down, and that would be just the first part, the second part, and then you have 5 waves up for a bigger wave 3, and then you have sort of sideways consolidation, which is usually a wave 4. It could be a triangle, so your 3, and then you get your wave 4, and then you get your 5th wave higher, and then you get a bigger A, B, and C correction. Now, the correction on the downside, the wave 1 is a little bit tricky because it can retrace up to 100% of this entire wave. Normally, the golden ratio is around a 61.8% Fibonacci. So let me show you CleanSpark, because obviously I didn't think we were going to get, I didn't think liquidity would tighten as much as it did last year. And so this is what I was sort of left with CleanSpark. We had a situation where we had an A, that there is your A, 3 waves down, triangle for wave B, C, 3 waves down, A, B, C, and then this here is 1, 2, 3, 4, and 5. There's what's known as a flat correction. And then from there, you have an ABC up for wave B. And then you have sort of like a 5-wave structure on the downside here. That's your A, B, and C correction. And I thought that might have been the end. And I made a comment, I should have thrown the kitchen sink at it because it was up like 100% in like a month or something like that. And I thought that might have been the low. But lo and behold, the market always gives you another opportunity. This ended up going up in 3 waves. So what does that make this here, this entire wave here? Well, it makes it just the wave A, just the first part of it. Remember, it can retrace up to 100% of the first wave. And so the way in which I looked at it was, okay, so this is going to be some sort of B, or in this case, it was an X, and then you have an ABC on the downside. But look at the symmetry. You got 75% for the A, 75% for the C. And then over here, we've got the entire wave here, which is 87% down. From the peak here down, it was 87%. So I added more at 184. I added more, which was where this was supposed to end. So this is another example where I added some in here, but I also added some right here. And the reason why I added it right there is, it's, Elliott Wave, but that's sort of where it went wrong. Melvin, what do I think about AMD at current prices and more broadly the semi stocks? Also, why did I cut pool? So I don't know much about AMD because I'm not following it as of right now. So I don't know where it's at. So I have no real comment on it. Semi stocks, yeah, I think it depends on what you're looking at. Some of them look quite attractive. Some of them a little bit more cyclical than others. Why did I close Pool Corporation? Well, I didn't just close Pool Corporation. I actually closed MI Homes and I closed Builders FirstSource as well. I closed the three of those. And the reason why I closed them is if you look at the mortgage rate, it's at 5.99%, right? 5.99%. Let me just leave that on the screen there. So mortgage rates have gone from 2% to just shy of 6%. I think it needs to get closer to 5% before housing starts to increase. So there's two things that need to happen. The first thing that could happen is wages continue to increase, right? So we get another 6% wage growth year, and then you see the affordability increases. So what do I mean by that? Well, the United States on average is $65,000 is the average salary. And if you're to get like this year, 6.4%, like what is that? 6.5 at 4,100 divided by 12, that gives you $346 a month. So if you were to get wage growth of 6%, 6.4%, you get an extra $346 every single month in cash flow. So if you think about the higher interest rate, wage growth would increase the affordability of houses. Now, in this scenario, for one, you're probably looking at another year to 2 years in order for the market to catch up if this mortgage rate doesn't come down. The other scenario is the mortgage rate collapses. And as of right now, the mortgage rate is not coming down. So it's more likely that we're going to see demand normalize. That's the probability I assign, like a higher probability that wages are going to have to increase in order to make it more affordable. And if that's the case, housing is going to be quite slow for the next year. We've already seen mortgage rates collapse. We've already seen mortgage applications collapse. We're seeing building permits collapse, which means that housing starts at some point in the future will collapse. That's not to say that house prices will collapse. At the margin, they might come down, but 40% of all houses in the US have no mortgage. So the leverage in the US housing market is just really not there. The concern that I had was this mortgage rate's not coming down anywhere close to what I wanted. And given that it was in profit, given that I had plenty of other opportunities where I felt like the probability, and that includes Lumentum, like the cash that I have in the on balance right now, that 12% or whatever it is, that came from selling out of these positions, that's going to go into companies like Lumentum. That's going to go into companies like Hasbro. Like there is other opportunities that I feel like the probability is probably a little bit higher. But even if housing works and the other stocks work, the expected return is still the same, or if not a little bit better. That's why I closed it. When I overlay Elliott Wave, like all of these were looking a little bit corrective in the near term. Now, here's the thing. If this does get down to much lower prices, I will be buying back into it. Absolutely. I think these companies are great. I'm just concerned that the activity is going to be quite weak for a while. And for those reasons, I decided to cut it, including Pool Corporation, because at the margin, they have 60% non-discretion, 40% is more discretion. What's the 40% discretion? Pool build-outs. And at the same time, it was pool build-outs and renovations. So when I looked at the intrinsic value of Pool Corporation, it was $412. So that was the intrinsic value on cash flows 5 years into the future. I just wasn't comfortable with that margin of safety to hang on to it. Builders FirstSource was trading pretty close to fair value. MI Homes was still deeply undervalued, but it's not very well covered. So we could have seen a scenario where MI Homes, the earnings were way lower than what were forecasted. But with Builders FirstSource and Pool Corporation, they were trading pretty close to its fair value. And I just didn't want to take the risk, to be honest. Builders FirstSource delivered 18%, and we put that on, like it was about 6 months ago. I thought the mortgage rate would be back down around 5%. It just never happened. Still in and around 6% as of right now. Actually, let's have a look. I think Bankrate is the website. Bankrate here, current mortgage rate, 6.43%. January 30th, 2023, for Monday, January 30th, 2023, the current average 30-year fixed rate mortgage is 6.44%. It's just way too high. So when I overlay what the chart structures were ultimately looking like they were playing out, and like you seen a moment ago, if we were to see wage growth over the next year, okay, fine. Demand will normalize at much higher rates because we'll see a scenario where earnings growth increases, right? 6.4%. Yeah, and so that'll take some time. And so in the next 12 months, they may be dead money. So that was essentially it. Zillow really jumped after I sold at 30, though whole of January being pretty crazy upswing for many stocks. Yeah, I mean, with Zillow, I think it's a busted story. And I think it's a busted story because of their business model. So look, I don't really like to trade something over a couple of months. That doesn't mean that I won't sell something if the story changed, like if the fundamental case changed. This I held on for a long time. I thought it was going to recover quite nicely. But the problem I had with Zillow was they guided 2.25 billion in 2025, right? So that was their EBITDA that they guided. And this was going to be on generating. So they got out of home buying. So look at where this is funny because a lot of people were trashing Zillow for getting out of home buying. And they were saying, bro, just go and buy Opendoor, because I had a little bit of a bump. Opendoor has just been absolutely punished, demolished over the past year. It's down 79%, where year over year Zillow's down 8%. So when you're looking at Zillow, Rich Barton, so everyone trashes Rich Barton. I actually like Rich Barton, the CEO. I think he's a fabulous CEO. And I wanted to show the difference between Opendoor and Zillow because what's his name? Keith Rabois or whatever his name is. He's like an insider at Zillow. He's like a founder. I don't think he's got much between his ears, but he was touting all over social media about how great Opendoor was. And the reality was the revenue was growing because they were buying more properties on leverage and they were accounting for that revenue growth. That's the property they bought. They weren't generating revenue. And so when you go into a little bit of a slowdown, you can't necessarily sell the houses for the prices that you wanted because the mortgage rate's now 6.5%. You have a big challenge. So when we're looking at Zillow and Opendoor, when they changed their business model, it was kids crying. When they changed their business model, sorry about that, guys. He's just home from school. When they changed their business model, what they were trying to do is capture returns across the value chain from an acquisition all the way to closing. And that includes, for argument's sake, advertising, title insurance. That includes everything across the value chain of buying and selling a house. Now, a moment ago, I was talking about why I closed Pool Corporation, Builders for Source, MI Homes. Mortgage rates too high. Activity in that space is likely going to be low for a while. That's not a view on home prices. That's just a view on building activity, transactions, because the cost of borrowing is pretty high for mortgages right now. And that's probably going to need like a year or two to normalize. So if these guys are guiding 2.25 billion, so that should be BN. If these guys are guiding 2.25 billion in 2025, it was only after that they guided that we seen mortgage rates spike from 2% to 7%. So I don't think they have a chance in 2025 to hit that number. That's not to say that in 27, 28 that they won't get there, but I just don't think they're going to be anywhere close in 2025. And it's a busted story over the next couple of years because of the massive rate of change in mortgage rates and how these guys generate cash. It's the value chain of their it's the value chain of buying and selling a home essentially. And so yeah, I mean, I closed this out and I put it into Lennox International, which ultimately I closed out at the end of the year. I think I actually closed it out on this spike higher. Now I made a couple of decisions into the end of the year to close out positions. So this actually ended up generating 30%. So I'm not that disappointed, but I closed it because I wanted to carry over. I wanted to offset realized losses last year with some gains. This wasn't a core holding. And I wanted to carry over the biggest unrealized loss this year. So we carried over a 22% unrealized loss. And part of the reason we were able to do that is getting rid of some of the winners, like smaller non-core positions like Lennox International. And we were using that against some of the losses we made last year. So we carry over 22% unrealized loss. That allows us to generate, up to 24%, sort of tax-free. At the end of the year, we can tax loss harvest as well and maximize that. And ultimately, one of the guys that got let go was Lennox International. Love the company. Bought into the end of the year, non-core holding, wanted to make the most of a bad year last year. Set ourselves up this year so that if we do very well, our tax burden is going to be quite low because we can offset an awful lot of realized gains into the end of the year. So Zillow, anyway, I originally swapped it out for Lennox International. These guys sell like HVAC, very profitable business, lost some market share, got back due to a hurricane. They rebuilt out their factory and they're starting to get back on their feet the last couple of years. They're expecting to steal back market share. The industry's grown pretty quickly. 80% of the revenue is from, so you buy a boiler, 80% of the revenue comes from when that boiler breaks down, they come in and fix it. And it's bloody expensive, let me tell you that much, because my boiler broke down one day and there was nothing wrong with it, but the guy charged me like $150 for 10 minutes. So it's bloody expensive. So anyway, that's essentially what this company done. And I felt like this company would be a better play than Zillow. Same idea, but it would be a better play than Zillow. And yeah, it played out very well. Any new conviction towards GoPro? GoPro still, like, I mean, my view hasn't changed. These guys are going to be reporting earnings soon. Let's see what the demand picture looks like. But this company is still undervalued. No change to my view. It's kind of creeping up over the past couple of months. I mean, it bottomed out in November, and even after today, I mean, it's up 33%. It's a pretty decent run so far, but it's in a diversified portfolio. I don't think it's worth it's trading at its fair value, so I'm just going to leave it alone. When you're looking at opportunities, are there any limits you stick to, i.e. market cap, country it's in, ADR? So yeah, there is, and it changes all the time, Patrick, to be honest. But I would look at, so I refuse to invest in Chinese companies in its current form, simply because they're ADRs, you have no claim on the asset, and you know, as a business owner, owning an ADR to have a handshake with a communist regime, it doesn't make a lot of sense to me when there's plenty of other opportunities that I can invest in. I don't have to own Chinese stocks. They might be cheap for a reason, and that's what a lot of people kind of miss out on. So I don't invest in China because I think there's plenty of opportunities elsewhere. But if there was more transparency towards their accounting, towards what their assets actually are, there's a significant amount of fraud that goes. There's fraud in every market, but there's a significant amount of fraud in Chinese markets. And it's just very difficult to really assess, you know, what's actually scaling and what's not. So I avoid that market. With regards to market cap, I generally look for a market cap greater than $1 billion. Sometimes if you have a company that's less than $1 billion, if it's lightly traded, even if you had $100,000 position, you can move the stock, believe it or not. And so you never want to be sort of patsy at the table, as Buffett says. You kind of want to be in a situation where there's plenty of exit liquidity to get out. So generally speaking, I look at $1 billion. And just to give an example here, we have Medifast. Some of the companies in the portfolio are less than $1 billion. This is a company called Medifast. So if you look at the average volume, it's 150,000 on average, 10-day average volume. At $110, you're looking at about $17 million. At the margin, my position is not going to influence the price. It's only $1 billion market cap. So that's sort of what the limits are, and then it goes up from there. ADRs, I'm not really against ADRs. I'm just against ADRs that are variable interest entities that have no assets backed by it. ADRs, there's nothing really wrong with it, depending on where it comes from. What is an ADR? This was thought about by JP Morgan many years ago. It's very expensive to list in the United States. So these are called American Depository Receipts, or ADS, American Depository Shares. And basically what would happen is, let's say I'm over in Spain here and I have a company and I want to list in America, but it's pretty damn expensive. I would take my shares here and I would send them over here, and they would go into a depository at JP Morgan. And then JP Morgan would issue depository ADRs, like shares against their shares in the vault. So you're not really you don't have any of those listing issues. It's kind of like a backdoor to list. ADRs themselves, there's nothing really wrong with it. The problem is, okay, the ADR, what are the shares? If it's a variable interest entity, I mean, a variable interest entity, like a lot of shipping companies can be these as well. I'm just a little bit more skeptical. I'm very skeptical of China because I got caught up in a fraud there, and I've seen an awful lot of frauds occur. A lot of frauds occur where what's being reported versus the reality of the financials, it doesn't add up. And it's very hard to see what's going on behind the scenes. Do I know what Michael Howell's view on Bitcoin is? Michael Howell, I think he correctly views Bitcoin as a barometer of liquidity, and that's what it is. It is a store of value, and it's very like frustrating to hear people say, "Oh, look, Bitcoin's down 70%." Bitcoin should have been down 70%. That's the thing that a lot of people admit. It should have been down 70%. So where I went wrong last year holding this is, yeah, I was expecting a correction, but I wasn't expecting markets to get as tight as they did for the reasons that I've mentioned a billion times. US debt levels are too high. The refinancing of debt is just going to cripple them. And it's sort of like a catch-22 where there is only one game in town, and it's easier liquidity conditions or austerity. And if you look at the actions of the current administration, they ain't cutting back expenditures. They're increasing expenditures. So the question is, where does that funding come from? Eventually, they run out of funding, and it's a catch-22, whether liquidity increases or it doesn't. I didn't think that last year we would see this big, massive drop, but we did. So Michael, so it should have dropped. Like, it's not like Bitcoin didn't perform exactly how it should have performed. It done exactly what it should have done. And again, the mistake was, as markets got very tight, it happened in a very short period of time. You can see it there. It happened inside 2 months. Happened inside like 2 months. That's where most of the damage was done. As we got very tight, very quick, around March, April, May, June, around that period, all of these assets dropped pretty aggressively. So it done exactly what it should have done. Now what we're seeing is liquidity improve. So as liquidity starts to ease, Bitcoin's starting to rise from the ashes. And that's what it's supposed to do. That's why I own it, because bigger picture, it's catch-22 where the market environment is going to be very dependent on the government being able to source some sort of liquidity. And I don't think the Federal Reserve are going to burn the US government, to be brutally honest. So my expectations are exactly the same as Michael Howell's. If we're about right and assuming that liquidity is possibly bottomed, well, yeah, Bitcoin should do very well. Okay, I'm going to pop on over here and have a look at the comments. I don't see. Okay, I'll have a look at that in a second. Let me go through this. Hi, Rob. Would love to know your thoughts, if any. Oh, okay, so we went over that. Would you consider opening a position in Nokia again? They had another great quarter. Yeah, Nokia is a fabulous company. Pekka Lundmark is a wonderful, wonderful, wonderful CEO. I've got nothing but compliments for him. And it was hard to let Nokia go. But here's the problem that I have with Nokia. Nokia is going to deliver probably 2 to 4% growth on the top line. So 2 to 4% growth, if Peter Lynch and every single study that has correctly noted that equities will, over the long run, perform equal to their earnings growth, a couple of things have to happen at 2 to 4% growth. One thing that has to happen is you need to see margin expansion. And that has happened. So they've gone from like 9.5% up to, I think it's like 13%, or that's where they're guiding 13%. So they're well underway. I think they're at 12.5% towards their target of 13%. So they're going to see margin expansion plus 2 to 4% growth. And on top of that, in order to hit our hurdle rate, like I've got a hurdle rate of 20%. In order to hit a hurdle rate of 20%, something else needs to happen in order to drive those earnings, because top line growth is slow. That other thing is share buybacks. Now, I sent a lot of emails to Nokia. Look, I believe I'm an owner of these companies, so I email these companies quite a lot. I rarely get responses, but anyway, I send it all the time. And I sent email, like probably about 4 or 5 emails to Nokia saying, listen, you need to buy back your stock in order to get the earnings per share higher so as your equity performs. I certainly didn't influence them, but that's sort of part of the thesis that I had for the company was earnings per share needed to grow above and beyond margin expansion and top line revenue growth. And where does it come from? Share buybacks. So let's say you have 100 shares outstanding. And let's say this company earns $10, right? So what does that mean? It means every single share earns, 100 shares, so 10 cents, whatever it is, doesn't matter. Let's say the shares get cut in half. You still earn $10. So the earnings per share doubles. So if you can do the share buybacks and you can reduce the number of outstanding shares, if the earnings don't move, well, the earnings growth increases. So you have earnings growth via buybacks, you have margin expansion, and you have 2 to 4% growth. All of a sudden, the company could easily be doing 15 to 17% plus a small dividend. And you get your 20% hurdle rate up for a long period of time because it's very, very, very cheap company. And so I actually sold Nokia after they announced their share buyback program. And the reason being is they announced $650 million over 2 years. And that kind of bothered me because this is a company that had $4 billion in net cash. It's producing about on average 2.3 billion per year. And the market cap, as you can see, is only 26.6 billion. So you have all of this cash. This is cash flow. This is cash, net cash in the bank after liabilities. And they do 600 million. It's not going to get you anywhere closer to this performance on the equity. And I think that's part of the reason why Pekka Lundmark is such a good investor or such a good leader, is because he's a really, really good, he's very conservative. He's very good at cost managing. He's very meticulous, but he lacks that aggression to get the share price higher. And I just don't think I'd be able to get the returns that I would really want from the company. That's nothing to say that the company is a fabulous business, great management. It'll do very well. But I just don't think it's going to hit the returns that I need to hit. I was looking at your holding, Digital Turbine. Not worried about the balance sheet because of solid growth, massive addressable market. But I'm trying to understand the business model and risks associated. Business model is unique because they have patents on their, I guess, own device. So they don't have a device on their own, so it's hard to compete. Okay, so... But about Apple, okay, so I don't think you understand the business model. Maybe they feel threatened of Digital Turbine, single tap product. Yeah, so I think you're missing a lot of details here with the business model. Can Google decide to not allow single tap anymore? Or maybe, yeah, so I think you're missing a couple of things with the business model. So basically my question is in relation to Digital Turbine and Google. So just from the outset, Digital Turbine's partnered with Google, right? But Google can't shut them down because they have their own DTID, and I'll explain their business model now. Digital Turbine, I don't think it's going to be able. I don't think there's going to be another company that will be able to recreate what Digital Turbine's doing. And the reason being, let's map out what the company actually does. So you got Digital Turbine here, smack bang in the middle here. So this is, we're going to put it down as DTID. So remember Apple ID and Google ID and all that sort of stuff. There was a lot of controversy around that. Share price actually dropped. A lot of people on social media haven't got a clue what they own, and they make a lot of shit up. All right, so be very careful. And that's exactly what happened with Digital Turbine. So this is where the business model is really interesting. So over here you have OEMs, and these guys are developing apps. OEMs. And over here you have carriers, and these are like T-Mobile, Verizon. So I'll just put like T-Mobile, I'll leave it there. You guys know it's T-Mobile. I'm using a mouse to do this. So we have mobile carriers, OEMs, original equipment manufacturers, but this is for applications. Over here we also have what are known as phone manufacturers. So this would be like LG as an example, and Samsung, and blah, 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 blah. And so where we are right now is, if you are very dependent on Google, so if you're tracking customers' information on Apple or Google, you've been kicked off. Digital Turbine hasn't happened. So if you look at the Trade Desk's revenue and you look for last year and you look at Digital Turbine's revenue, one of them collapsed, the other one didn't. The one that collapsed was the Trade Desk. And it's funny because the Trade Desk is trading at 12 times the valuation in terms of market cap than Digital Turbine, but they're doing the same amount of earnings. Digital Turbine's a really beautiful business. So this is the really interesting part about this business. They get the customer information from the carriers. Their digital turbine ID is embedded into the phone when it's sold, and they're connected to an OEM. So they don't need to track customer information through Apple or Google. So they're not getting kicked off because T-Mobile, Verizon, all of these different companies are feeding them with that information. They're already embedded into the phone when it's sold. And so they can take the customer information through their DTID. They can pair up OEMs and already have pre-downloaded applications on the phone. So the OEM is going to pay some money. So why on earth would LG and T-Mobile, etc., partner up with Digital Turbine? Well, they get a percentage of it. So then you could say, well, why doesn't just LG do it themselves? Well, then LG has to create this relationship. And then you have to say, well, why would T-Mobile actually do business with LG? Well, they wouldn't. They wouldn't, because if they do business with LG, they're blocking off another market with Samsung, etc. And so this is a really unique situation that I don't think is going to be recreated, where Digital Turbine is actually embedded into the phone. Their DTID is embedded into the phone when it's sold. They already have the customer ID, and the OEM is the one paying the sort of like the advertising dollar to Digital Turbine. It's a really, really beautiful sort of situation, and it's very, very, very efficient. I think their click-through rate was something like 36%. Think about that. So we're talking about Amazon. Amazon's advertising has a click-through rate of 10%. That's insane. The average website is 2%. They done a study, Digital Turbine done a study, and it was 36%. Why? Because they're embedded on the phone, they have all the customer information, and they're downloading specific apps to that specific person that will be very useful to that specific person. You probably on your phone, if you've got an Android, which is like 80%, 88% of the market, you probably have Digital Turbine on your phone. They're not with Apple, but the vast majority of phones sold is Android, Google. So that's what makes the business really unique. And that's really what makes it very secure. But, you know, it takes a little bit of work to figure out the business model. And because it takes a little bit of work, nobody's willing to put that work in. It'll only be fairly reflected in the earnings as they continue to, like, think of it this way. They own 3 different acquisitions. One acquisition is difficult because you got to integrate one team into an entire business, right? So one acquisition is really difficult. They don't 3 acquisitions. And not only did they integrate those 3 acquisitions, they delivered 27.5% growth on the top line, on the bottom line, despite the top line coming in 7.5% short, or 7% short, because mobile was down 16%. Absolutely phenomenal execution. So over time, I know people are lazy. They're just not going to bother actually looking at what these companies do. So they'll make that shit up 9 times out of 10. And that's fine. But eventually, as the earnings continue to be solid and solid and solid, people will pay attention to it. And then they'll make more shit up about it as to why the company is so amazing. And then it'll start pricing it in. Happens every time. Happens every time. It's very easy to spot a bullshitter. Really easy to spot a bullshitter. There's no shortage of them. I recall you saying before you had a long short strategy. I recall you saying before you had a long short strategy before. You mind speaking about that a bit? Yeah. Okay. So when you're looking at risk comes in many different forms, right? So when people say they're managing risk, it doesn't necessarily mean that they're managing the volatility in a portfolio. Risk can be balance sheet risk, right? So you can have your balance sheet risk. You can have industry risk, right? So if you look at something like Tyson Foods or Pilgrim's Pride or Calmine Food, we're seeing avian flu increase, right? So what kind of risk is that to the company's future earnings if 4 million birds get bird flu and they can't produce eggs and they have to be euthanized? It's massive risk, right? So risk in itself has many, many, many different forms, lots of different forms. So when you're doing bottom-up analysis, risk management in bottom-up analysis is really, really, really different to risk management for a long-short portfolio. You still have to do the work, though. You still have to do the work. So basically what I was doing was it was a long-short portfolio. was a long short portfolio. There are a couple of different types of risk. So the first risk would be market risk. So think S&P 500 broad market risk. An airplane flies into the World Trade Center and the stock market closes for 10 days. It's complete exogenous risk. It's market risk. And it doesn't matter the fundamentals of your business. When the market reopened after September 11th, what ended up happening was the market was down like 10%. That's market risk. And so that's the first risk. The second risk would be sector risk. So that might be like financials broadly, as an example. FIN after 2008. So you can have a fabulous business, but if the entire sector is in free fall because of completely reckless lending, that one bank that is really solid is going down regardless. The whole sector is going down. It's getting pure liquidated. That's what's known as sector risk. And then you have what's known as industry risk. But these are basically what I'm saying is these are just different layers of risk, right? So you have S&P 500. So a long short portfolio could be I'm long individual equities and I'm short so individual sectors, a diversified portfolio of individual sectors, and I'm short the S&P 500, right? And just in case an airplane flies into the World Trade Center, it's a completely exogenous risk factor. Just in case we have COVID and we go into lockdown, just in case any of these things happen, if the market sells off, it'll offset my individual book. So I'll always have a short against the market, but that short is insurance. It's not there to make money. And most people that want to do a long short portfolio, they short to try and make money. And they leverage up those shorts without realizing it's an asymmetric bet. And they might make money in the short term, but they almost always give it back and some, because either they get their fundamental case wrong or they're way too concentrated and they're using way too much leverage. So when you're looking at long short, removing market risk would be, we have a portfolio of assets, we're going to short the market. Those outcomes are so rare, like every 10 years, there might be an exogenous risk factor. I don't bother shorting the market. If I own a solid business and the market went down because of COVID, over time, if the business didn't change, it would recover, or I'd reduce exposure on the way down, or whatever it may be. But that's sort of the way in which I look at it. I want to be long only outside of that. And if I see strategic opportunities, I might remove market risk. Strategic opportunities. Go back to 2019. What happened in 2019? We're in a manufacturing recession. It used to be a lot easier to predict these things. It's a lot more difficult today because you have high inflation, GDP is very high, consumers are very negative in terms of sentiment, but they're still spending like crazy. And so there's a lot of different currents that make today very difficult. So that's the first part. The second part would be sector risk. So financials, doesn't matter what you own. You could offset, you could buy individual banks, and then you could short XLF, right? So what you're doing is you're trying to buy the best of the bunch and you're trying to short the market against it, and you're making the spread between it. If you're a really good bottom-up investor, you'll make a spread. Will you beat the market? Who knows? And then finally, you have industry risk, where let's say I wanted to go long Generale in France, a French bank, which is a trade that I made, and I wanted to short BNP Paribas. Well, there's a couple of things I could do. I could just do equal weight positions. Like, let's say I've got a portfolio. I want to have 20 positions, 10 long short. And I've got whatever. I'm going to put $1,000 long, $1,000 short. You can just weight it that way if you want. Or you could do beta weighting. So let's say one bank is like 1.2 beta and the other bank is like 1. Well, the one that has a beta of 1 should have a bigger position because it's less volatile. So you could beta weight it. But anyway, this is essentially what I was doing. I was looking at an industry. I had a little bit of an edge where I could find a company that should outperform another company, and I levered up 5 times. So my portfolio was 500% leveraged. But the reason why I was 500% leveraged is because I was still looking to beat the S&P 500. And the only way in which I could literally, can you imagine buying Google and selling Microsoft, or buying Microsoft and selling Google? Your returns are going to be pretty miserable, but they're going to be quite safe, because if anything happens in the tech sector, all of tech is going down. And as long as you have the best quality company, you'll make money on the upside and the downside. And that's what's known as an absolute return. So I was looking to generate absolute returns, leverage portfolio, and it worked for a while, but it requires a lot of discipline, and I didn't have the discipline at the time. And when you're dealing with that type of leverage, you make one mistake and you're going to pay for it. And back in 2015, I was up 50% for the first 6-7 months of the year. Into August, I was down 30%. I was back to break even inside 3 or 4 days. Why? Lost discipline, got rid of some of my short exposures, thought I was the best in the world. Listen, these longs are going to keep running. The shorts are holding me back. The shorts were meant to be there. The leverage was offsetting the expected returns. So that's why I stopped doing it. And then when I took a step back, I'm like, I could probably do this successfully and I could probably make a lot of money, but I could also just have no leverage and just invest in, a basket of 20, 25 companies. And over time, hope to beat the market. So that's essentially what I was doing. Offsetting industry risk. So it would be like McDonald's restaurant brands, one long, one short. It would be like Adidas, Nike. It would be like, General. It would be like JP Morgan, Citigroup. It would be long, short, two similar businesses, but one has a slight edge. And at the end of the year, you might make like 3% on that position. But then the carry costs and all you have to factor in as well. So it can be quite expensive if you make the wrong decision. So just be very careful with it. To me, no leverage, focus on solid businesses, write the volatility out, you'll be fine. Don't get complicated. Are there any companies in my current portfolio that I would hold for the next 10 years? I never, ever, ever commit to 10 years. I think it's the dumbest thing you could possibly do. And I'll tell you why. Because I would say less than 0.0001% of the population thought COVID was going to lead to lockdowns in 2019. And the reason why I bring that up is because there was a lot of good, solid retail businesses that went out of business because they didn't have 6 months, 12 months of cash in order to sustain a period where the business is literally not generating anything. And so if that can happen inside like 3 months, what do you think can happen in 10 years? A lot. And so what I do is I like to look for a company that's good. Like here, I'll give you an example. Like Cameco is an example of a company where I've held this for a number of years. I might hold this for a decade. I don't know. But I started buying this back in 2016. Now the fundamentals didn't change, but I wasn't making any money 4 years later. And so it took time for the fundamentals to play out. But quarter in, quarter out, year in, year out, I'm following the management, I'm following the fundamental case for the stock, and my fundamental thesis didn't change, so I'll just hold on to it. And even where we are today, I'm surprised we're this high where uranium prices are. Uranium prices are still very low for long-term contracts. You need to get uranium up to $60, $70. So can you imagine when uranium does get to $60, $70 a pound, this thing is like $100 a share. I still think there's some work that needs to be done, but there's an example of a company where will I hold it for a decade? At this stage, I would say I'll probably hold it for a decade, but I never committed to it. When I bought into it, I thought I would be out in like 2 years. It's always the same. Another long one, Transocean, is one that we entered it into the portfolio. Back in 2020, Transocean, I couldn't buy it. I think it got to a point where the market cap was so low and eToro couldn't get any shares. But I didn't buy it the absolute low. But I was thinking down around 60 cents, I wanted to buy it. It was a $650 million market cap. They've since issued a lot of equity. So now the market cap is what? 4.7 billion. But at the time, back in October, I was thinking somewhere down around there, like I'd add it to the portfolio, but you weren't able to on eToro. I've held this since 2020 and it's been a bumpy ride. 1, 2, 3, 4. So there's been like, yeah, it's quite volatile, but it was, in my view, very much undervalued. We're starting to price in a fair valuation for the company now, but it's getting, it's been in the portfolio since 2020. So I bought that in May of 2020 at $1.27. And so I'm heading up for 3 years on this. Will I hold it for 10 years? Maybe, I don't know. I'm not going to tell you right now, this is going to be my portfolio at the end of the decade. When people say I'm going to hold this for the rest of my life, they don't know what they're talking about because most companies go bankrupt or get acquired. So I people that have, are enamored by companies, the whole point of us investing is to make money. It's not to join some buddy social club. Hey, listen, we're all investors in this company. Great, fantastic. Now, where's my money? And that's sort of what I think a lot of people forget is we invest to make money. We don't invest for a social club. A lot of better, cheaper ways to get those social interactions. So is there companies in the portfolio? If there are companies in the portfolio that I'll hold for the next decade, I don't know which ones they are, because I'll be straight up. When I look at Cameco, I never intended to hold this like 2016, October 2016. Later this year, I'll be in at 7 years. I never intended to hold this for 7 years. Now, where we currently are, the fundamental thesis hasn't even played out yet that I thought was going to play out back here inside 2 years. It hasn't even played out yet. So is there another couple of years left in this thesis? Yeah, absolutely. But I never intended to hold this for as long as I did. So I have no idea which one will be there and which one won't, if any. I have no idea. No idea. So last one, Digital Turbine. Some general questions. How do I keep away from the YouTube, etc. noise, recession, no recession? How do I don't watch YouTube anymore. YouTube, in my view, is such a shame. But I think it's both content creators and viewers on YouTube, because like people are literally, they'll watch a video and say nothing. They will invest in a company with like their entire savings. Now you have no idea who this person is, but they just watched, like, I'll give you an example. The YouTube channel that I had on average 48% of every video viewed. So those that watched the videos weren't even watching it to the end, and people were making decisions based off that. And obviously I knew that was going to happen. I didn't think it was going to happen to the extent that it did, where it's like you're like diversify. When money's coming in hot and fast because we're in a bull market, everyone wants to be concentrated, and that's just financial ruin. And I thought that, that starts off the big, massive noise. So that's in a bull market, what I didn't like. Now we're going through a bear market. And of course, everyone's now a macro analyst. Now, I don't really know what's going on YouTube. To be honest, I don't open it. To be honest, I don't even really open Twitter that much anymore. I have it open right now because I was actually going to play a clip here from, I just post some stuff that I think is interesting, but I'm not really on Twitter that much anymore either. I'm just staying away from social media. Look, here's the thing. I think if you want to be a good investor, you have to be able to make decisions for yourself. You can't be swayed by someone else's view. I like listening to certain people because I think that they are really well calculated, really well educated. They come with a good argument. And it's very, very, very easy then for me to say yes or no, whether I should go a little bit deeper into what this gentleman or gal is saying. But yeah, there's a lot of noise. I think if you want to get away from that noise, recession, no recession, reset, silver, explosion, all that sort of stuff. If you want to get away from it, I think the best thing to do is stick your head in a book and figure this stuff out yourself. And then you'll be able, you'll be able to spot a lot of inconsistencies that you hear out there. The problem with macro, as an example, which everyone's a macro analyst, you can make anything up. But one thing you'll see is that if the price is going, like, here's another thing, the winners write the history books. So if we have a look at the S&P 500, just as an example, one of the worst periods in history we call the Roaring 20s. We had 4 recessions during the Roaring 20s. So there's the Roaring 20s. Show me a recession on that there. So we call this the Roaring 20s, yet we had 4 recessions in that period. See how macro can turn a narrative into anything? Market went up, so it was the best period in history, but we had 4 recessions. Anyone that had assets made a hell of a lot of money, but anyone who didn't got their butt kicked. So I think narratives with the after COVID, the doubling up of volume from retail investors and the access to social media, I think noise has gotten very heavy. Look, these are just my opinions as well. I mean, I'm not saying it's right or it's wrong. There's a lot of people on social media that have great content, but nobody's willing to listen to it because it takes more than 5 minutes to extrapolate a reasonable argument. What's more important and successful, macro investing or bottom up? I think if you were only to choose one, I'd focus on bottom up. But if you were to get to a reasonable level of understanding with macro, again, it can be like you can say anything as macro as long as it's big picture. You can call anything macro, but really all that's important is understanding what actually drives asset prices. Liquidity is what drives earnings. If credit starts to expand and you start to see demand increase, well, growth is going to increase, inflation is going to increase, and there you go. That's most of your earnings. And so if you can understand liquidity, everything else in macro is noise. Bottom-up investing, if you're to only look at one, focus on the bottom-up fundamentals of a business. Okay. That's the last question. Oh, there's a question here. Ronnie, where do I spend my time? Where do you spend your time? On Ticker? Where do I spend my time every day? What do you mean, Ronnie? Like, where do I spend my time when I'm looking at different companies? I have a lot of companies in the portfolio. Like I've got 25 companies in the portfolio. So some of them might be like by the time you finish earnings season, it starts again. It usually starts with Citigroup. So, you'll listen to the earnings call, like banks are usually first. So I'll give you an example of how you can kind of get sidetracked and stuff. Citigroup's the business that we own, and you're listening to the earnings call and Banamex comes up. Banamex. This is more like bottom up, but anyway. Banamex. And they're going to sell Banamex. Now, they were looking for 15 billion. That's what they wanted to sell Banamex for, 15 billion. But they're going to get 11 billion. And is that good? Well, it's bloody fantastic. So the reason being is Banamex is literally appraised at 4 billion inside Citigroup. So by them spinning off this asset, Banamex, selling it for 11 billion, they'll sell that for 2.75 times book. All right. So I'll hear in the earnings call, okay, I got to write down this note. I got to go and investigate and figure out what's going on here. Okay, they're going to sell this for 2.75 times book, probably going to buy back their own stock with 11 billion, which is about 11% of the company with the capital raised, and it's priced at 0.6 times book. Okay, fundamentals are intact if that plays out. That's exactly why we own Citigroup. So that's sort of one example. So that's sort of when we're looking at the individual companies, when we talk about appraising these stocks week in, week out, month in, month out, it's not that you need to keep on top of them every single time, but you need to like follow the quarterly reports, follow the annual reports, try and investigate like where we are in terms of our thesis and valuation, continue to update all of the estimates. Like I follow them all here. So what I follow here is the portfolio. Some of the companies we mentioned earlier, Hasbro, Lumentum, QVC. And what we're looking at, so Google's pretty useless in terms of the data here. There it is there. We want to keep up to date with the estimates, the growth rates, the valuations. We want a good idea of what we own. So I update this on a weekly basis because there's a lot of estimate changes. We want to understand where intrinsic value is based on present value of cash flow. Is the company generating value? Weighted average cost of capital minus return on capital. Just keeping up to date with this stuff. Then after that, it's about searching for ideas. A couple of different ways you can search for ideas. You can screen out different ideas. So you like, here's a screener that I'd look at where return on invested capital greater than 15% per year. And then I can change the year. So I can look at trailing 12 months, 21, 20, 20, 28, 2019, 2018, look for a market cap greater than $1 billion for the reasons I mentioned before. Some of the countries I'd be comfortable investing in, fetch screen. Has any of this changed? If it has, like return on invested capital is a pretty good idea of the company's ability to generate outsized profitability. It's a self-funding company. It can reinvest in itself. So you might find some ideas here. And then you start scrutinizing its valuations. I've got valuations there. So that's one way. Another way is like I have some lists here where I will literally go over here and I'll go out to the weekly chart and I'll literally just go like this and I'll just go down. These are all, I have 3,100 companies and I'll literally go over all these companies like this all day. And I'll look for patterns that look interesting. And then I'm like, okay, that looks like an Elliott wave pattern. I wonder, does the valuation stack up? Okay, the valuation looks undervalued. Okay, this is trading at a 50% discount to fair value and the chart stacks up. Let me understand this business a little bit more. And so there's many different ways. Peter Lynch said, listen, it's all about turning over rocks. I do this full time. To be honest, I just love doing it. If this was a video game, this is what I would do all day. It might be boring to other people, but to me, it's not. And so you can put 1,000 into each one. I've got 1,000 in here. I've got the S&P 500 in here. So we've got all the companies in the S&P 500. I've got the highest return on invested capital in here. And that's what I do all day. And I just keep updating it. And that's it. And then I filter out lists where I need to do a little bit more work. And then I understand a little bit more about the company. And then I decide, okay, is this a company I want to buy? Okay, when? So you look at 3M. Recently bought into 3M. But I decided I was going to buy 3M on its earnings. That's its earnings report right there. I'm not going to chase the stock higher. It just got away from me. It put 5 waves in. Okay, now we've got a little bit more higher probability that this here is possibly the general direction of the trend. Then we're waiting for that correction. So I decided back in October I wanted to buy it. I only started buying it in December. And then I bought some more about a week ago or whatever, a couple of days ago. I don't know, last week sometime. But anyway, that's what I do all day. And I love it. And there are certain things that other people might like that I may not like, but this is what I enjoy doing. Can you give some names who are worth listening to? So there are a couple of people like this. There's this. So Nick Timiraos is from the New York Times. Is he the New York Times? Wall Street Journal. This guy is assumed to be the whisperer, the Fed whisperer. There's a lot of people I don't agree with. Like this guy here, Alex, he used to be a Goldman Sachs investor. Some of the stuff I don't agree with, but he's an intelligent guy, knows what he's talking about. And yeah, I like to follow people that don't agree with me as well. So I have different view to this guy, Alex, but he's a former Goldman Sachs investor. He got booted out for whatever reason, I don't know. But got intelligent thoughts. He's very interesting. There's a little bit of, you got to put up with a little bit of noise in there as well, but some of the stuff that he puts out is very good. This guy here, like there's a lot of very specific people. This Lake Cornelia Research Management, very specific to energy. So I'm invested in Transocean. Before I only followed Schlumberger. They had fantastic insight into offshore. This guy's able to pull stuff that I didn't even see. So it's great to follow. I only started following this guy recently. I've seen a very interesting chart, which he aggregated the data. Bob Elliott's another guy, fantastic. Certain things I don't agree with him, but he's very articulate in his data. So I follow a lot of people on Twitter. I don't go on it as much because it can get repetitive. So if you look at Bob, very much into labor, wage growth, etc., the data, which is what I agree with. Vincent Delurde, little bit different view, but on the inflation side of things, we're like I agree with these guys in different places, but it's nice to have them all in one place so as I can sort of better understand. And these are all like portfolio managers. They're not fly-by-night type guys. Mike Green, completely disagree with his view right now, but these are spaces that I mentioned before that are very interesting, different perspective. Like I've got different perspective 1 and 2 there. Matt Cochrane is very much bottom-up investor on specific companies. And I was looking at Moody's a while ago and like, here you go. This is the thesis behind Moody's. This is why everyone goes to Moody's, because your interest expense is a lot lower if Moody's give you a rating. And to display that like that, it's so easy when somebody says to me, hey, do you like Moody's? Sometimes it's hard to really articulate your view. There you go. I'm just going to send them that. There you go. That's why I like Moody's. That's why Moody's is in a very dominant position. Anyway, I follow more people on Twitter. It's easier to filter out the noise. And yeah. Do I think this week with Fed and major earnings might bring volatility to deploy your remaining capital? Do I think this January mini bull run might end? So look, I didn't think we would run as fast as we did. But at the end of the day, it doesn't really matter. Like we could do 100% this year. And to be honest, it really doesn't matter. It doesn't matter because then next year we got to start again. And what if we're down 50% next year? We just patted ourselves on the back for 100% gain and we gave it all back the next year. It doesn't make any sense. So the game never ends, but people cheer small wins. I don't know why. So if we have volatility in the near term, does it matter? Not really to me. What matters is bigger picture. Will I be right over the next 12, 24 months? Secondly, I kind of do hope we are going to get a decent correction because I am looking to allocate some capital and I want Lumentum Holdings to get down. Like I think it could get down as low as 53. I don't know if I'm going to be able to get in there, but this thing has been pretty resilient and I'd like this to get down a little bit lower. So yeah, I do hope we do have a correction. Qurate Retail, I've watched this go from like 160 up to 250. I thought this would have came down a little bit deeper. It never did. And I sort of missed the first part of the move. So I'm kind of hoping there's a correction. I've got about 12% cash available. 3 companies I'm looking at: Qurate, 4 companies: Lumentum, Hasbro, and Amadeus. And I'm hoping to deploy that in the next couple of weeks. And I do think we're going to get a correction. There's a lot of companies in the portfolio that I think, like you look at Warner Bros. Does it get a slight higher high? I don't know, but these moved very quickly in a very short period of time, like from trough to peak, 72.5% in what, 2 weeks? This is a 4-hour chart. That's like 2 weeks. So there's a lot of companies that went up significantly. We did already reduce sort of exposure in positions like Crocs, which is another one that went up pretty damn significantly since last July. This went from trough to peak up 180%. So yeah, there are some positions that I've raised some cash and I'm waiting patiently for the correction. Everything else in the portfolio, not worried about it. I don't think it's at its fair value. Where do I usually listen to earnings calls? Is there a website or resources to listen to them? So normally what I do, Patrick, is I prefer to read the transcripts. So let's say it's BH Bulletin. I prefer to read the transcripts because sometimes when I'm listening to it, I might miss parts. So I prefer reading the transcripts. And I just highlight areas that I think are very important and formulate a view on the earnings. And that's what I do. So normally you get down the juicy part of earnings usually comes in the comment section. So it should say here, operator, next question, and it goes through all these different questions. The Q&A is usually the interesting part where an awful lot of the presentation is scrutinized. So I prefer to read it than listen to it personally. Yeah, it could be. I haven't used that app. Can you please analyze the chart structure of RIG? Screamed high extremely. Idea of cutting the position a bit. So Transocean just got a lot of upgrades recently. These guys do a quarterly report, or is it monthly? Anyway, they refinanced recently. They won a couple of contracts. They refinanced recently. That was so with Transocean, people thought the company was bankrupt and therefore it was being priced for bankruptcy. They've just refinanced. They've pushed maturities way out and it ain't going bankrupt. The thing about Transocean is during the last bull market, these deep sea rigs, the shipbuilders got absolutely screwed. And if you listen to Valaris, which is a competitor of Transocean, if you listen to Valaris, a lot of the shipbuilders got absolutely ripped apart, so much so that they won't do business. They can't. So a lot of the shipbuilders started building a lot of ships during the last cycle. And then as a lot of these deep sea players, like there was so many deep sea players, like go back a couple of years ago, is Diamond Offshore still there? Diamond Offshore is still there. You had Noble Energy. These are all restructured. Ensco ended up. Ensco. Who did Ensco merge with? Or C, was it? No, not Ranger Resources. Anyway, there was loads of them. A lot of them went bankrupt. They went to zero. Seadrill, SDRL went to zero. I was short that company. It's obviously restructured or whatever. But anyway, a lot of them went to zero, and they burnt a lot of these shipbuilders, so much so that the shipbuilders went bankrupt. So you had a whole decade of no revenue coming in the door. And what ends up happening? You lose all the talent. People stop getting educated on how to build these ships. So there's no high-grade human capital to actually build these ships. And the ship yards that are still in business are not doing business with anyone unless they have 40% down at least. So that's a lot of cash for these companies that they just don't have at today's interest rates. And that's what management have been saying. What does that mean? It means that when you have 88% utilization rate for offshore rigs, it means that these rigs that currently exist and the newest Transoceans, it's like literally bricks of gold in the sea. They're literally bricks of gold. That's how I view it. And so I own a company that has $12 billion roughly of shareholder equity, which is mostly assets of these rigs that are just pure gold. That's the way in which I look at it. So I look at the company, the cycle offshore is growing 15% year on year. Onshore is flat. You're seeing a lot of new contracts won. You're seeing capital expenditures moderate for Transocean. They just got their 2 new ships. And these guys are unhedged. So the thing is, when you're looking at earnings, and I'm going to show you what I have here for a discounted cash flow model for the company. When you're looking at earnings, you got to take it with a pinch of salt. So the intrinsic value is coming in, when you calculate the present value of cash flows, coming in at $8.60. And I say take that with a pinch of salt because these earnings continue to get upgraded and upgraded and upgraded. We're at an average of like 440,000 day rates. You know, they could theoretically into the cycle peak double from here, which is all cash flow. And then you're looking at unlevered cash flows, not at the billion, but probably closer to 3 billion plus. And the equity is dirt cheap. And you get this asset, which is not going to depreciate because you can't replace it. The replacement cost, you could probably sell these assets for a premium versus what they're worth. And so when I'm looking at Transocean, I'm always very skeptical to sell it because it's a very unique business. When we're looking at the equity performance, yeah, it's done very well. It's done really well. The way in which I'm looking at, and I could be wrong here because this could still very much be in some sort of wave 3, 4, and 5, right? So when we look at the present value of cash flows, as of today, it's coming in at about $8.60, which is still, I don't know, my brain's fried, 31% on the upside. There's still 31% on the upside. So there could be a number of other upgrades. I have been thinking about, as we get closer to 860, maybe skim 30% of the position, get paid for the risk that we've taken, and then let the rest of it run. Let it run wild. And that's sort of what I've been thinking. But that's sort of how I'm looking at it. I think we're really only just starting, to be honest. But yeah, it's been on my mind what I should do. I'm not doing anything right now anyway. I came in late. Did you already look at Amadeus? I see they have a low cash position, but high additional paid in capital retained earnings. Does this mean if they needed cash, they can exchange this for from additional paid in capital and retained earnings? Could the following conclusion be true? Cash position is a risk, but due to healthy equity. So I think you're getting really deep there to the point where I think the answer is probably a little bit easier than that. So if you look at Amadeus, so what do these guys do? They're in-home care. I haven't spoke about it, by the way, because I haven't invested in it, and I don't like talking about stuff that I haven't invested in. I spoke about Hasbro and I spoke about Lumentum, but generally I'm not planning on talking about stuff I haven't invested in. But Amadeus is, yes, it's one that I like. So when you're looking at the company, what do? These guys do they do in-home healthcare services. So nursing for elderly patients, hospice if somebody unfortunately has terminal cancer, hospice segment, like that's essentially what they do if people have Alzheimer's. So in America, if you look at the trend, it's really value-based care is on the up and up. So what that means is, let's say somebody has terminal cancer Value-based care would be stay in a hospital, live out the last of your days in hospital, or transfer back home and have all of the amenities that you need in your home. And it might be cheaper, but it also might be a lot more beneficial for, unfortunately, the person that might be in their last couple of days or weeks. And so what Amadeus do is, in that example, they would provide the in-house care. Where they generate revenue, most of the revenue comes from Medicare, Medicaid, and it comes from insurance companies. There's a small amount of revenue that comes from out of pocket from customers, but not a huge amount. Most of it's Medicare, Medicaid, and insurance companies. Medicare, Medicaid, very sensitive to government rebates. Government rebates generally have trended positively, but we're at a point where debt's very high. So you have a situation where you have an aging population. They expect that they have all of this pension money, all of these liabilities. They pay taxes their entire life. Larger portion of the population is now going to be retired. So the government would have to make a difficult decision. Austerity or continue wide deficits. I think we're going to continue wide deficits. So I think that Medicare, Medicaid is fine. But at the end of the day, if somebody has terminal cancer, it's not discretionary. So there is a cyclical element of their income, and that cyclical element of the income is government rebates, but it's really non-discretionary in a lot of their revenue. And the reason why I bring that up, Dan, is because when we have a look at financials, yes, the balance sheet might only have 17 million, but if we have a look at the cash flow state, well, if we have a look at their estimates and their cash flow over the last couple of years, it's been pretty healthy, right? 150, 190, 166 million, and all that gets funneled back into the business. So although the cash position is low, yes, you can dip into your retained earnings, but cash flow is fairly stable. And in fact, if you look at any business that's a really good compounder of capital, their capital needs are pretty low. And like if you look at Pool Corporation, I don't think Pool actually have a lot of cash either. They don't hoard a lot of cash either. So if you have a look at Pool Corporation, I think these guys actually, I can't remember what exactly, 85 million. This is a $16 billion business. They've never had a huge amount of cash. I think Lennox International was something similar. Good quality capital allocators will always find a home for that cash. I think these guys had a low amount, 48 million. A lot of these good quality capital allocators, they don't generally have a huge amount of cash on the balance sheet. They're pretty good at allocating capital. And if you look at Amadeus, I mean, if you look at its return on invested capital, are they good at allocating capital? Well, they're pretty decent. They're not terrible. There's been some challenges in the last year or so. Margins have been increasing, but we've seen return on invested capital come down ever so slightly trailing 12 months, but it's still above its weighted average cost of capital. And they've been pretty decent with profitability and allocating capital. I'm not too concerned really at all. What's my thesis for BioNTech moving forward? Obviously, I have a fantastic balance sheet. Yeah, I don't think you're going to get a better balance sheet than BioNTech's. So let's just start off there because it's sort of the way in which I looked at it. So you have 13.4 billion in cash, and then you got accounts receivable sitting at it's at 7 billion. 7.3 billion. What is that accounts receivable? Governments owe them money. So it's B2G. It'll take some time before that ends up in their bank account, but both of those are effectively cash. And that's against a payable of 296. So net, you're looking at like $20 billion pretty much in cash, liquid cash that the company has. So 20 billion in cash on a market cap of 34.9 billion. So what are we getting for 34.9 billion? Well, if we pop on over here and we have a look at estimates, they have their COVID vaccine. The COVID vaccine is going to sell probably 250 million doses per year to the commercial sector, and that's going to moderate cash flows down to like $1 billion. Over the next couple of years, you can see it moderate down to about $1.5 billion is what it's suggesting here. It kind of moderates 2025, it kind of bottoms about 1.4, 1.5 in and around that region. So you have this COVID vaccine that generates cash flow of about 1.5 billion. At the current valuation, you're paying $14 billion for that, 15 billion. So you're paying 10 times cash flow for the COVID business if you exclude out the cash. Capital leases they're including in enterprise value. Personally, I'm not a fan of using capital leases for a completely different reason. But you're paying about 15 times cash flow for the COVID business. Then you have the early stage pipeline. So it takes about roughly 0 to 7 years to go from clinical trials, phase 1, 2, 3, and then commercialization. You're looking at about 7 years. So they got 2 drugs that I thought were very interesting. Whether they're successful or not, I don't know. But they've got melanoma, early and late stage, big market, growing market. There's no cure for melanoma. And that's in phase 2. So I thought, look, I'm not paying a huge amount for the business because there's loads of cash there. Now the equity valuation has gone all over the place. Equity's all over the place despite having no debt and tons of cash and still generating cash flow. But I'm getting all of this cash. A COVID vaccine, which is probably going to replace influenza. Over 65s will probably keep taking it. 250 million is the forecasted dosage from the commercial sector. I assume nobody else takes it. And then let's say the melanoma drug is actually successful. Add a couple of $1 billion, significant amount of free cash flow to the annual returns in terms of profitability for the business. It's a huge amount. And so it's like the way in which I was looking at was little downside, huge upside. Now, if you look at BioNTech, it's been pretty volatile recently. I'm possibly going to sell out of it because there might be an exogenous risk factor that we need to consider. So they partner 50-50 with Pfizer on the COVID vaccine. And I didn't realize what was going on. It was kind of selling off and what I thought was no news. One of Pfizer's executive was caught on camera saying that they were planning on mutating the virus themselves to sell more vaccines. What a PR disaster. And so although there might be 20 billion in cash there, you never know what might end up happening to that. If there's legal cases, if those legal cases are lost, could they sort of take some of that $7 billion that the government still own them back? I don't know. And so there's some of the risks that I see at the moment. But I'm watching BioNTech. I don't think it's expensive for where it currently is, but I could see this path playing out where the wave 2 actually finishes over here. So I'm thinking maybe I might take it off the table if we bounce higher up towards 166, 170, wait patiently, see what happens, and then revisit it. The fair value is coming in at 234, maybe a little bit more actually. I can't remember. BioNTech 225. So the fair value is coming in at 225. It's pretty volatile because a lot of that valuation is coming from, you guessed it, the cash. So if the earnings again, if melanoma was approved in the next 1 or 2 years, well, that number is new all-time high. And that's sort of what I was looking at. So that's sort of what I'm looking at the moment. I think it's going to bounce. I may take the position off the table in the near term and revisit it at some point in the future. And this, from going back to a chart perspective, this might end up being some sort of A, B, and C. So we'll see. We'll see. That's sort of what I'm looking at the moment. But that's why we diversify. You're probably going to be right more often than you're wrong. But you are going to be wrong. There's a high fail rate in investing. And concentrated portfolios, what happens with concentrated portfolios if you're wrong? You lose like 20, 30% of your book on one position. It's too much. It's too much. Look at, what was that? Saga Partners. They're down 95%. Pretty insane. Institutional grade investment, I think. I'm not sure. I don't know what their AUM was. Let's see, actually. Well, it's way lower now. I guess they've shut down. Last reported share, yeah. Anyway, I think it was Saga Partners. Concentration down 75 or 95%. 95%. Now they were up a lot during COVID. The portfolio total return is down 40% since inception. So it's not like it's at zero. They did have a couple of good years, but too much concentration. Companies like Roku, etc., and with higher terminal rates, you're just not going to get away from it. All right. Okay, guys. If anyone has any questions, fire away. If not, I think we might end it there. I don't know how we're doing today. Digital Turbine's down. 5% is what it is. Baxter, I'm looking forward to their earnings. We just built out a position recently in Baxter. Taking advantage, obviously, of all the negative sentiments. Good quality business, down 50% past year, 47%. I think it's high time that the market starts recognizing it. So we've been building out a position. I'm done there. It's about 4.6% of the book. And yeah, after that, just need to put the rest of the capital to work, which is $12.47%. Because this is live, and it's about 12.47% based on the current value of the portfolio. All right, guys. We've got 12% in cash, so I don't think it's going to be. Anyway, we had a good run up until now. We're going to get a correction sooner or later. All right, guys. I think I'm going to leave it there. I don't see any more questions. I really appreciate your time and your patience throughout the last year or so. Bumpy ride, but it's markets. Overstock CEO Jonathan Johnson recently revealed in an interview that they were currently generating $1.5 million per employee. Yeah, that's top line revenue. That's not really giving any insight. So if you go, and the reason why it's so elevated is because of their business model. So if you go FinViz, Overstock, OSTK, they get 3 to 5% margins. They've got they've got 1,350 employees, and they do what was their revenue trailing 12 months? That's revenue anyway. No one cares about revenue. We care about profit. So 2,137 divided by 1,350. Yeah, you got 1.582 million. We care about profits. We care about, it's like 3 to 5%. So each employee generates how much profit? So each employee, 1.5 million multiplied by 0.0, let's say 25. Each employee generates 37,500 in profit after all expenses. Not bad. It's pretty good. When's the next live stream? Ronnie's asking. I think we'll do it every 2 weeks, which would amount to less than $1.5 billion a year. Is that not concerned? No, you're talking about revenue per employee. It's more about profitability, and the margin that they generate is going to be relevant. It's only going to be it's going to fluctuate depending on a bull market, bear market. So as we go back into a bull market, they'll go from the lower end of 2% back up to maybe around 5%. It's the business model in which they adopted since Johnson & Johnson took over in 2019. It's like a drop shipping type business model. So at 5%, for argument's sake, you would be looking at times 2. Each employee would be bringing in 75,000 in profit after all expenses, operating profit. So yeah, it's not concerning, because here's the thing with Overstock. Overstock is only priced off literally, if you look at its cash flows, which have been cut in half, its estimates, which I don't agree with, because I think they're going to be quite volatile. It's not very well covered stock, but based on current estimates, the equity, the furniture business is valued at $22.09. Medici is not even factored in there, and most people don't even know Medici exists. So that's part of the opportunity. I would make a bet. Well, no, I don't really like to gamble, but I would make. I would be willing to. Well, I'm pretty confident in suggesting that we're probably going to see one spin-off. I would say it's probably going to be the CBDC business, BIT Global, spun off. And that's the first time the market's going to realize that Overstock has more than just a furniture business. And then that whole asset is going to have to be appraised. And that's where it really gets exciting. That's the bullish case for Overstock. But I think we get one spin-off. then we start to fairly reflect the valuation of the business. It'll take some time. Any opinions on Terry Smith? I think Terry's great in his own unique way. We obviously have differences in how we look at markets, but his record speaks for himself. The guy has billions of dollars. He's got way more money than I do invested in him. So he's been doing it longer. He's got a good track record. I mean, anyone that makes money in this business deserves respect. So Terry's no exception. Fabulous investor. Okay. Did I leave anyone out there? I didn't. Okay, we're good. Okay, guys, I'm going to leave it there. Have a wonderful day, everyone. Really appreciate all your time, and we'll probably do it again in about 2 weeks. So have a great day, everyone. All the very best.